I told you last year, AMD is going to significantly outperform NVIDIA. That's exactly what we're seeing. The Middle Eastern country is talking about taking out a ton of oil facilities around the region. That's peak scariness. This stock is insanely undervalued. The entire company right now is selling for about $300 million. I don't really see there being a middle point. This is either a generational buying opportunity in companies. You're going to produce very abysmal returns over time. All the software stocks are going from one investor class to another. Money has to go somewhere. People that have a lot of money, they have to put it somewhere. This is as V-shaped recovery as you get it in the stock market, folks. I don't care if we have a crash of 50%, stay invested. That almost never happens. Opportunities I see out there in the market, and there's some incredible opportunities. I've got to tell you, every time the market drops since the great financial crisis, listen, we are in a time period with insane moves. We have a lot to get into in today's video on where certain stocks are going, where the market's headed, things like that, opportunities I see out there in the market, and there's some incredible opportunities. I've got to tell you, for anybody that has a longer term horizon, let's call it this month or next month, okay, so a lot to get into in this one here today. We got some big tech stocks moving big in the portfolio here today. Amazon's up about 4.5%, up $15,000 on that stock here today. AMD's making a nice upward move. Meta stock, we're up about 16,000 on that today. Public count having a nice day in general, but there's certain stocks inside the public count that are getting damaged, and they're all like the SaaS type stocks, right? SaaS apocalypse continues on. Look at Salesforce, CRM, down another 4% plus here today, down 14% on that stock. Look at Palantir's down almost 8% today. Adobe's getting hammered. ServiceNow's under $90 for ServiceNow, right? We got to talk about these SaaS stocks, if there's opportunity, if there's not, if this is like a generational buying opportunity in regards to these SaaS stocks, or it's just a pump fake in the end, right? Then we're going to talk about some stocks in general. Then I want to react to 3 little clips here. One is Tom Lee. He says the bottom is in. I'm looking forward to reacting to that one. Then we're going to react to Dan Niles. Dan Niles, always very intelligent. Chip stocks will get stronger as the year progresses. That's very bullish. AMD, if you're an AMD shareholder out there, and other chip stocks as well, but certainly AMD. And then we're going to listen to Halftime Committee talking about their favorite opportunities in the market, and I'll share my opinions and perspectives on that, the market, all those sorts of things. Got a lot to go through in this video here today, folks. I appreciate you joining me. One thing only I need from you. If you could just smash that like button, that would mean the world to me. And that's it, man. That's all I need from you, okay? If you want to be subscribed to the channel, you can certainly subscribe. It is free to do so, and we have, I don't know how many subscribers on this channel now, but it's a lot. I think it's 130,000 plus. Appreciate each and every one of you for being here, okay? Alrighty, so listen, let's just talk SaaS stocks first, okay? Salesforce, Palantir, they get grouped into this. What is going on, okay? Listen, these stocks are selling off because specifically the IGV is just being sold relentlessly. The IGV today down 4%. If you're anything in the SaaS related space, software in general, you have no chance if the IGV goes down 4%. Like it's just like dominoes, just boom, knocking one over after another, right? Look at these stocks today. It's Palantir down, 7+%. ServiceNow down about 8%. Even stocks like Shopify. Shopify, you look at that as an e-commerce company, but they even get grouped into being kind of like a SaaS related company, right? Software. And look at Shopify. It's getting Shopified. Down 6.5% here today. Adobe, this stock's so cheap, it's ridiculous. And it's down another 4% here today. Salesforce down 3+%. Any of those sorts of stocks, you have no chance in this market as of right now if the IGV sells off 4% every single day, right? Now, listen, this is either like a generational buying opportunity or it's either or. I don't really see there being a middle point. This is either a generational buying opportunity in companies like Salesforce, Adobe, ServiceNow, or they're all going to zero, and Wall Street's right in that, right? But there's really no in between in regards to this, right? You're looking at valuations now. Salesforce has a forward P of 13. 13 for a company with double-digit top-line, bottom-line growth for likely the next several years? 13 forward P? Like, don't forget, these have always been the best business models we've ever seen in history, right? Crazy. Adobe's at a 10 forward PE, with next year expected earnings per share growth of 20% and next year expected revenue growth of 9.4% at a 4P at 10. Adobe's price, like if their business is never going to grow ever again. They're never going to grow earnings per share again. When you start pricing at a 10 forward P, basically that's Wall Street saying you're never going to grow again, right? We'll see. We'll see. So far they've been growing and growing and growing and growing. Maybe it just stops tomorrow, right? ServiceNow's down to a 21 forward P. Now ServiceNow looks expensive compared to these stocks, but keep in mind ServiceNow is a company that on a trailing 12-month basis has earnings per share growth of 23%. On a trailing 12-month basis, revenue growth of almost 21%, right? Next year revenue growth expected of 18%, and next year earnings per share growth expected just under 20%. I mean, forward P of 21, come on, man. So my belief in regards to this is, do I believe it's a generational buying opportunity? Do I believe all these stocks are going to zero? I believe it's a generational buying opportunity. That's my personal opinion on this, right? And maybe I'm wrong. I think ServiceNow at $89 is ridiculously undervalued. I think Salesforce trading where it's trading right now is ridiculously undervalued. I think Adobe in the 220s is ridiculously undervalued. That's my personal opinion on this. We'll see what happens as the years tick on and all this sort of stuff, but I just think really it doesn't matter what you think right now. The thing is, Wall Street's going to sell these stocks off in a relentless manner regardless, right? And these companies just have to come through with the numbers. They come through with the numbers as time ticks on here, they'll bottom and they'll start going up. But man, what a just brutal sell-off. And this isn't the first time this has happened in regards to these stocks. They've had this happen in the past. It hasn't happened in a while, but it has happened in the past to these companies. And it's happened to a lot of other companies, right? So we'll see. We'll see what happens, right? People are happy to pay $600+ for Meta now. And those same people, weren't willing to even pay $100 for Meta back in 2022, right? Did Meta launch some game-changing new product service since then? No, they haven't. It wasn't like, they came out with the next Facebook, no. Like this, all their core products are still their core products. And yet now people are happy to pay $600+ for Meta today, literally today, when they were not. People are happy paying $628. They think they're getting a steal deal on Meta, when these same people wouldn't pay $100 or $88 for it back, 4 years ago. So that's what you have in the market, right? Silly, silly times. Okay, so next up here, Amazon wants 250 plus. That one's getting moving again. Great to see. Revolve's one of the most underrated small cap stocks in the entire market. Great income statement, great balance sheet, great management team at Revolve, RVLV. They just execute. Elf seen a nice bounce back here today. Elf's got a long way to go. Long way to go in terms of recovery. I think that's a $150, $200 stock long term, right? Over the next several years. So I believe a lot in Elf. EL's very undervalued. Anything under 100 is a steal deal for EL. Cheesecake made a nice upward move here today, 2+%. That's always a deal. Meta's a deal as long as you got a long-term horizon, right? You're going to have to take big hits from depreciation, which is going to hold back earnings per share over the next several years. We know that, right? Nike up 2% here today. Good to see that one moving and grooving. AMD with a 2% plus move. AMD now 236. The stock remains very, very strong. This has had a heck of a past year in terms of AMD. The 1 year in AMD, look at this, 198%. I told you guys, I told you last year, AMD is going to significantly outperform NVIDIA. That's exactly what we're seeing. NVIDIA is not up 200% over the past year, right? NVIDIA's done well, but it's just like AMD's at a whole different level. And the reason being, as I explained a million times, if you've been watching my videos, AMD has the major growth now at this point in time. And what's going to happen is the revenue growth acceleration of AMD is going to surpass the revenue growth acceleration in NVIDIA over the next several quarters. And that's going to be very exciting. It's like a passing of the mantle, man. Other than that, Celsius up about 1% here today. And a lot of the damage is really in SaaS stocks specifically, right? So a lot of pain in regards to that. You even look at something like Palantir. Obviously, Palantir is going to look very expensive compared to these other stocks, but obviously the growth rates for Palantir are unbelievable. But Palantir is funny. The forward P is actually under 100 now, right? Which usually you wouldn't say is exactly a screaming buy. But with the company's revenue growth and earnings per share growth of this company, it's actually not bad. But it doesn't matter. It doesn't matter. If IGV sells off 4% a day, it's all going down in Chinatown. But it's just getting ridiculous. It's getting ridiculous. IGV now, let's take a peek at this one. IGV, it's surprising that over the past year, it's only down 4%. But year to date, 28%, 6-month IGV's down 34%. Just brutal, man. Brutal. Let me go ahead and look at my potential buys watch list here and see what's going on there. So ServiceNow, very attractive at 89. I might be a buyer of that stock tomorrow. Follow me on my Patreon, or if you're in the private group, don't be surprised if I buy some ServiceNow tomorrow. Other than that, Amazon, I'm probably good on Amazon. Probably take that off my potential buys watch list. Looks like RH was up about 3% here today. Bath & Body Works was up. That's one I want to really start a position, but we'll see. Whirlpool's up to 56. I'd love that one to go back under 50, but we'll see. SoFi looks attractive at 16. Keeping an eye on Robinhood. I just don't know if I trust Bitcoin still, and it's hard to trust Robinhood stock if you feel like Bitcoin might still go down, right? So there's something to keep in mind there. Big tech stock. Oh my gosh. Oh, Snowflake down 12% here today. Brutal, man. I mean, I wouldn't even necessarily call Snowflake a SaaS company, but you wouldn't know. Look at the 6 month. 6 month on Snowflake down 48%. Oh my gosh. Intuit down another 7+% here today. Intuit? No way. Year to date, Intuit's down 45 flipping flapjacking percent. Oh my gosh. The crazy thing is, we use QuickBooks for our small businesses, and are we switching off QuickBooks? No, absolutely not. Like, are you crazy? But you would think all their customers are leaving. I'm like, this is wild. Let's look at Intuit's valuation now in this stock. Man, this is crazy times in regards to these stocks specifically. Intuit, forward P of 15 for Intuit. Forward P of 15 on Intuit. Double-digit top-line, bottom-line growth. This is really interesting. I don't know what else to say. Like, wow. Alrighty, let's react to some videos. My gosh.
As you see here with us at Post 9, it's good to have you back.
Great to see you.
Now what for these markets?
I think the bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down. So that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs, and I think maybe get to that 7,300 that we were expecting this year.
Wow. So let's just remind and refresh people's memories a bit. You were looking for a strong start to the year, stocks falling into potentially a bear market.
Yes.
Most of that you pegged to a new Fed chair coming in and some of the issues that might revolve around monetary policy. Couldn't foresee the outbreak of this war and the conflict, et cetera. Does it matter what caused the bear market for how you project your outlook for the year?
Before we go further here, listen, ladies and gentlemen. If you want to say, has the stock market bottomed, right? Has the market bottomed? It's clear as day. It's not even a debate. Has the stock market bottomed, right? Like, the Nasdaq's up over 10% from where it was a few weeks ago. That's a bottom, right? Like SP 500's up 8%. Now, could the stock market crash again, or have a correction? Who knows? Weeks from now, months from now, years from now? Sure, it's the stock market being crazy. But, I mean, you don't just go up 10% on the Nasdaq. I mean, now it's pushing close to all-time highs again, right? I mean, the Nasdaq's not down that much from all-time highs now. It's gone up so much. It's down like 4%. And the S&P 500 from all-time highs is only down 1% or 2%. So, yeah, that's bottom has been hit, right? Now the question is, are we about to accelerate to new all-time highs and go from there? That you can debate, but I mean, this is as V-shaped recovery as you get it in the stock market, folks. That is the V. That is the V, okay? Like, when we talk about V-shaped recovery, that's what we're talking about. Just like that.
Or are you confident that we had this event, an existential event for the market, it reacted negatively, and now we're going to rebuild our way back?
Yeah, I think things have possibly changed, Scott, because this war pulled forward a lot of repositioning. We know people have gone flat or raised cash. And they were ready to own defensive positioning. And we also had a rolling bear market last year in energy and financials, and this year in Mag 7 and software. So something like 70% of the S&P's already been through a rolling bear market. So I think the possibility is that the summer lull that could happen won't be as deep because we've already fallen 8%.
What's the makeup of the move back towards record highs, like you just said you thought we would do? What does the makeup of the market look like in that scenario?
I think the leadership has been revealed in the last 6 weeks because since the war started, the number one performing asset class has been crypto, Ethereum, and then energy stocks, Mag 7 software, financials. So to me, that's the group that's leading us up. Energy went up for obvious reasons.
Sure. Isn't it going to go down now for obvious reasons?
Yes. And then the negative correlation to oil was the highest in almost a decade for the Mag 7, Ethereum, and software. So I think that as oil flattens or cools or the curve flattens, those names are going to get a bid, and they've gotten already cheap. We know the Mag 7's trading almost at a market multiple.
When we sort of banked on the broadening trade, there was a bent towards value, which had outperformed growth. Is that mostly over now? Because even with oil elevated, we're still going to ask ourselves questions about a slowdown in the economy, right?
Yeah,
or no?
And there's still a shock rippling through the economy.
Which we maybe haven't felt quite yet?
Correct. Yeah, I think there's an inflation shock still coming. I think that the broadening is taking place. The narrowing is, I think, more investors are going to buy U.S. because the U.S. has proven its resilience in this wartime period. Plus, the U.S. makes more money in a war. But the broadening is that more U.S. stocks rise. Yeah,
but if you're telling me the inflation shock is coming, isn't that going to negatively impact the broadening trade?
Yeah, I think it is out there. We just don't know amplitude because, it's like a wave. Like when it hits shore, is it going to be diminished and are people bracing for it? But there should be some inflation shock coming. It sounds like the Fed is already thinking about, still leaning towards cuts, which is good. We'll get some signal.
Well, right now they feel like they're leaning towards doing nothing for the foreseeable future. And if they believe what you just said and believe, then you must believe that they're going to remain on hold for potentially even longer.
Yeah, and it really depends on if consumers and corporates view this as temporary or a change in inflation. So the surveys will matter a lot, as will the incoming reports. But the Fed Fund futures show the market's shifting back towards cuts.
All right,
so the most interesting thing, in my opinion, when you look at those stocks, what stands out to you? What stands out to me is we're witnessing the move back to big tech, right? And the exciting stocks that, everybody was excited about before last earnings season because things started to deteriorate as you went into earnings season. And then, as the Middle East stuff got closer and closer, right? But big tech performed really strong, like the Amazons and the Metas, all the stuff that was performing strong before you got to last earnings season. And then stocks like AMD, certainly, right? And then also the stocks that were already really weak were the SaaS stocks. Those stocks already were getting hammered, right? And so now we're focusing on kind of the same plays of like big tech, and no one wants to own SaaS. So it's just interesting. The market moved right back to how it was positioned before. Dan Niles.
Portfolio manager at Niles Investment Management. Dan, good to see you.
Good to see you too, Mike.
So, semis, obviously it's been kind of the lifeblood of this bull market leadership for 3 years. It's changed. I guess we got to be specific in terms of which chip stocks or themes we're talking about. But how are you viewing this latest burst of enthusiasm for custom chips and some of these other kind of subsectors?
Well, I think if you step back and you think about what's gone on with chips, the first really 3 years since ChatGPT showed up at the end of 2022, it's been all about training and then about inference this last year. What you're seeing this year, though, with OpenClaw being the big, event at the end of January, is that you moved to this age of agentic AI. And so what you've seen with tokens production is it's gone from growing about 20% over the last couple of months before OpenClaw at the end of January to now it's over 130%. And so this lull I think you've seen in chip stocks, I think you're going to see them get a lot stronger. You're going to have to be selective, but I think you're going to see them get a lot stronger as you go through the rest of this year. because of that move to agentic and the massive increase in compute that takes.
In that context, you mentioned we kind of transitioned away from the GPU training focus we were in for so long. Does it make sense to you? Does the market have it right that NVIDIA has been just kind of sideways for the better part of a year?
Yeah, the market did have it right. But what should encourage people if you own NVIDIA is the fact that today you had an event that could have easily knocked NVIDIA down, which is Broadcom had that big deal between Anthropic, Google, and themselves. The stock was up 6%, but NVIDIA closed the day up. So I think from a short-term perspective, you see these digestion phases. I've talked about Cisco in 1997 and 98, how it was down 37 to 38% intra-year, both of those years, and it finished those years up 31 and up 150%. And I think NVIDIA is sort of in the same category where people have rightfully concerns because of what you're seeing in terms of the market getting more selective around the eventual winners. But this move with agentic requiring a lot more tokens means that I think NVIDIA ends the year higher than where it is today, even though I think OpenAI, you're going to figure out, has a lot more problems than investors currently think.
That's interesting. Now, I was going to just ask about the companies that are kind of creating all this demand for the semis with their CapEx budgets. Are you among those who feels like we're at a point where the only thing that's going to make like a Microsoft work better is if we do start getting CapEx cuts, or maybe Meta, or have they gotten cheap enough on their own?
No, well, I think it depends on why you get CapEx cuts. I think with Meta, if you get a CapEx cut and they say, hey, we're cutting back on all these science projects we have going, or, Reality Labs, I think people will like that, because if you look at this most recent quarter that they reported, they were the only ones that had a really strong return on investment, meaning that the CapEx went up a lot, but the stock, I think the next day was up 10% or so. Reaction to earnings, because the revenues got revised higher, as did the earnings. So I think with Meta, that would be taken positively. If you get a CapEx cut at one of the big cloud providers, so Amazon Web Services, Google, or Azure, I think that's a different problem, because investors are giving these companies the multiples they have because they're viewing all of them as winners. And I don't think that's why I'm saying you're going to have to get more selective. I mean, and you're seeing it with Anthropic coming out and saying, hey, we're raising prices. And at the same time, OpenAI is coming out and saying, well, we're having to cut prices because now, to me at least, it looks like Anthropic's got faster or higher run rate revenues at around 30 billion versus OpenAI's last estimate of around 24. And obviously, OpenAI started this back in the end of 2022 with ChatGPT.
Yeah, the moral of the story is here, ladies and gentlemen, the market keeps going risk on. AMD's outperformance, so the market's going to get way more extreme than this. So this is just kind of looking at the lows of the market recently. SP 500's up right around 8%. AMD was up 22%, right? This will get much more extreme if this market stays risk on. Next thing you know, you'll see AMD 275, you'll see AMD 325, and moving from there. Okay. All right, last one up here. Let's talk some more stocks in the market.
Let's show you the markets. You'll see exactly what I'm talking about. It really didn't look like that, but 10 minutes ago was red.
By the way, so you guys know, the pinned comment down there today, how to manage a portfolio at every stage of wealth. I filmed you guys like a 35-minute workshop on exactly how to run a portfolio, protect your portfolio, how to build and scale it, whether you've add a few $1,000s in your portfolio or tens of thousands, hundreds of thousands, or millions. And workshop goes into all that good stuff. So you can send it over via email or via text, however you want to receive it. That is free to access, and that is the pinned comment down there today. The second pinned comment will be if you're looking to apply, join my private stock group, get access to all my course curriculums, private Discord chat, 1000xstocks.com, all that super in-depth stuff, okay?
Flat-ish. Now we've gotten a nice move kind of everywhere in the market. So there are questions about the durability of the ceasefire. I think everybody can understand that. Even so, there are some folks like Fundstrat's Tom Lee who say enough positive things have happened that the worst is clearly behind this market. Here's what he told me yesterday on Closing Bell. Listen.
The bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down. So that's a good precondition. And today now we have the rate of change that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs.
Okay, so we'll go to Josh Brown first, who looks to us today to be doing his best Rodney Dangerfield back to school moment at the University of Miami, better known as the U. What do you think? I mean, I don't know. It's like you have to address the backdrop. What are you doing?
I am at the Herbert School of Business at the University of Miami, which is celebrating the fact that they have just broken into the top 40 business schools in America for the first time, well on their way to a top 20 business school in America. So, okay. But let's address the issue at hand. I think what Tom said is spot on. When you have continued bad news and stock prices stop reacting to it, that's a wake-up call for people who have been pressing their bets on the short side, that maybe they might be overstaying their welcome. Last week, we saw an explosion in people buying puts. We saw a huge move into cash in a lot of areas of the market. And I think we got to the point where we had sufficiently beaten up multiples for growth stocks. And we'll talk about some of the Mag 7 names in a minute. But people just looked at that and said, okay, I get it. This conflict could drag on. Maybe it doesn't. It's impossible to know. Even the people most responsible for the decision making themselves do not know. But here's what I can tell you. Earnings growth revisions are still trending higher. Analysts continue to take their numbers up. The first few companies that we got had nothing but good things to say. Look at the Delta news about what's happening with corporate customers, regular households, consumers. And it's enough is enough. And I like that backdrop. I wouldn't suggest to you the bottom is definitely in, but if I had to bet one way or the other, I would bet we have substantially digested a lot of the negatives, and now we're going to hear some great things from companies as they report. So I said this on Tuesday, the amount of positive pre-announcements looks great. The amount of negative pre-announcements is really low. And here we go.
Yeah, well, I mean, here we go. The market's clearly going, as you see. The S&P is only 2.5% away from its all-time high.
Yeah, it's amazing.
Feels crazy to say that, given everything that we've been through. I know, the ceasefire development was enough to give this market a big bump. This latest news that we're showing you on the bottom of the screen here regarding the Israelis and Lebanon, that has moved the market in the last several minutes. What do you think about what Tom Lee had to say and now how this environment looks?
So yesterday I was in Washington, D.C., and I had one for the client. And to your point about, it's only down so much, I said, improbably, unbelievably, your portfolios are still in good shape. I think it stuns everyone when they look at the actual numbers and see that the market's essentially flat.
What's so scary? What's so scary? Oil price went up. Everybody's got to pay more at the pump. Maybe that leads into small amounts of inflation and everything else, right? Because transportation cost goes up, right? And that has happened for about, the past month, maybe 2 months, month probably, right? That destroys the whole economy? That's going to cause everybody's earnings to miss or tank? It's crazy. Now, I understand if oil exploded to 200 and stayed there for 6 months, because then you say, oh gosh, okay, now we got 6 months of super high gas pricing, 6 months of, maybe potentially more inflation in the economy and blah, blah, blah. But a month worth? You think that's going to destroy everything? I think the economy is, just a little more resilient than that. I mean, you've had a lot of things thrown at the economy the last several years, and somehow we make it through, right? So it's going to take more than just a month of high gas prices to say, okay, we're finished.
Lots of strategies are actually up. So with Tom Lee's comments, I think he's right. I just come at the same perspective with a slightly different path to getting there. I think we got very close to the brink. I think we looked over the edge and we didn't like what we saw. And as an investor, What I bet on is I bet on President Trump's self-preservation tactics and instincts. And I think when we were at that ugly point on Tuesday night, nobody wants to see oil go to 200. Nobody wants to see the Middle East get any worse. That's worse for everyone. So, so where we are is backing slowly away. I agree with Josh that the bottom may not be in, but I also think that our worst case scenario is a lot less bad than it used to be. And, and I'm working on my client letter. And you know me, Scott, I generally skew negative, right? So I'm writing this letter and I'm working on my outlook. And it's frankly kind of hard to skew too negative because what you have is earnings that are expected to grow 16% this year over next year. Earnings that are expected to grow another 16% in 2027. And interest rates that, while they might not be going down, they are unlikely to continue to go up. And at the bottom of all that, at the bottom of the market is interest rates and earnings. And you have a consumer that I'm skeptical about the health of the consumer. We're all on board with that. It's a K-shaped economy and a K-shaped consumer. But you hear comments from Delta and Levi's, and they're saying, look, the consumer is still in okay shape, particularly the high-end consumer continues to grow. So even I'm not that dark in this moment. Wow.
Kevin, timestamp this moment.
Thank you.
Please.
But I'm not buying Apple yet.
That's
so
all right.
It's not too crazy.
This is a historic moment in the anthology and the history of this program that something has occurred that Jenny Harrington is now
not that dark.
The sun has come out, ladies and gentlemen. What can I say? Malcolm, what do you think? What do you think about where we are here? I mean, feels like the market is now looking for an excuse to go higher.
Yes.
All you need are some consistent headlines and feeling better about the broader scenario of the Strait and peace talks.
So I think Josh and Jenny have put a lot of technical reasons around this and given it some very good sounding reasons for why this market wants to go higher. Frankly, I think it's just the FOMO trade. It's literally the knee-jerk reaction to, we learned our lesson with Liberation Day. We saw the NASDAQ go up 10% in one day, basically, when we got the all clear via Twitter. And no one wants to be on the wrong side of that trade. And so whether it's too early now or we're very close to this finally being the ceasefire that ends it all, no one wants to be wrong and no one wants to miss out on that trade. And we can see it based on what people are buying right now. The only thing that's, I think, going to matter here is tech and financials, because that's where the opportunity is. Those are the things that have been sold off the most. And that's what everybody's crowding into at the moment, trying to right size their portfolio holdings.
Not everybody, I guess, is on the same side of the bullish boat yet. Jim, like Piper's Craig Johnson says, not convinced that the market's out of the woods. And he points out that, at least in his mind, to maintain a new bull cycle, it's going to take a combination of things, namely...
Hold your horses for just a moment. Yeah, certainly not everybody's on the bullish side. There's still a lot of people skeptical about this rally, skeptical of the market in general, skeptical about what stocks are going to go up and not. Like, there's still a lot of skepticism in this market. And let's not forget, just last week, literally just last week, we were deep into extreme fear in the market. Extreme fear, deep into extreme fear when it comes to fear and greed index. So, yeah, people aren't just like magically feeling like great and like, the grass is green everywhere right now. That's not how it's working. So that's something very important we kind of keep in mind here, ladies and gentlemen, okay? Once again, pinned comment down there today will be, if you're looking to access my 35-minute workshop, it is free to do so. That'll be the main pinned comment. Second pinned comment, if you're looking to apply, join private stock group, private wealth group, get access to 1000xstocks.com, private Discord chat, exclusive weekly videos, all that good stuff. Plus some moves I'll be making tomorrow in my portfolios, and I got some moves I'm making indeed. Look at that, ladies and gentlemen. Posted this on my X page here today. Public count up $115,000. I mean, just an absolutely massive move here. But there's a lot of interesting things that are going on in the stock market with the internals of the stock market. So looking at the VIX here today, down 17%. It is still up 43% year to date. So the volatility has spiked up in a massive way, obviously, this year, although it is crashing in the very short term here, right? Look at crude oil. Crude oil down about 16% here today. Keep in mind that's still up 64% year to date. So we're talking, we've got a long way to go in regards to getting some of these things down, right? GSG, I think, is one of the most important things everybody watching this right now should be tracking. GSG is going to let you know if there's going to be big inflation coming into the economy as time ticks on. And GSG is up a shocking 34% this year. A lot of that is due to oil, but that's a huge move. But it was down 7% plus here today. So this is good news. We need to keep this moving if you want to think about rate cuts, the Federal Reserve cutting rates. If you want to think about the 10-year potentially going down, things like that, we need GSG to go lower, and it's substantially lower from actually where we're at here today. Look at Metastock here today. Metastock, we're up about $39,000 on Metastock here today. Just an absolutely unbelievable move for a stock that has been in rough shape in regards to the stock price. The fundamentals of the company we know are amazing, right? But as far as the stock price goes, it's been in a rough place really for the past 6 months roughly, right? Look at AMD. AMD stock up about $24,000 here today, now up over a double up in the public count on AMD, up now up $304,000. This stock positions very well. The more risk on this market goes, you'll see AMD fly. 325 could be up next for AMD if we go risk on for a while here in the market. Amazon, this is another stock that wants, a lot higher prices. This stock wants $250, up over $10,000 here today on Amazon. $124,000 now up on Amazon. This is the fun part, right? When you get a little flip in the market and you start seeing some of the green out there, it's like, whoo, man, if you could get a few weeks of this or a few months of this, risk on, oh boy, we're going to be talking about whole different levels for a lot of our stock price and a lot of our portfolios, right? Look at Celsius here today. This one's up $6,400, about a 4.6% move here today. Meanwhile, you got party poopers out there. Palantir's a party pooper. That stock down, 5.6% here today. It's a pretty big downward move for Palantir. We're still up 1,829% on that stock. Salesforce, another good example. That stock down over 3% here today, down 33% year to date. Okay, 4 core subjects I want to get into in this video here today. One is this just a fake out rally we just got, or are we about to go risk on now? Or is this market about to, let's just call it, move up substantially from here? We'll talk about that at the beginning of this video, and I'll share my opinions, perspectives. 2, what about these party pooper stocks like Palantir, like Salesforce, the others, let's call it SaaS related companies? What is going on with them? When do they start to move? Those sorts of things. We'll discuss that in this video. Okay. Number 3, I'm going to tell you exactly how much cash I'm sitting on now at this point in time, how much of it I've used up, obviously, in all the drama over the last couple months here. And number 4, we're going to talk about what new stock I am most likely to buy. I will be sharing that in this video here today. One thing all I need from you guys, if you could please just smash that like button, that would mean the world to me. I hope you appreciate me doing these videos for you each day, and I certainly appreciate you guys joining me, and all I need from return is just a little smash that like button. Make sure to subscribe to the channel. Also 921,000 plus subscribers now on the channel. Pinned comment down there today, free workshop I recorded for you guys. It's a 35-minute workshop I recorded a few weeks ago for you guys. That's basically how to manage your portfolio at every stage of wealth. So I don't care if you got a $5,000 portfolio right now, a $50,000, $500,000, $500 million. It doesn't matter what stage you're at. That video goes in depth in regards to that. Can send it over via email or via text, however you want to receive it. It is free for that workshop. Okay. All right, ladies and gentlemen, let's listen up. Are we at the start of a new upcycle swing? Okay. So looking at the Dow here today, massive day, obviously, for the Dow, up way over 1,000 points. NASDAQ up huge, S&P 500 up huge. International markets are up big, right? A lot of people excited about the whole ceasefire situation, everything like that, right? So first thing I like to look at is just like, how does it look, right? Are we in some sort of V-shaped recovery? And that's a V-shaped recovery we're in right now. That's pretty clear, right? This is no like, oh, we got a little bounce here. No, this is substantial now, right? We got a clear V going on here. And, there's just really no debating that, right? Now, the interesting thing about this V-shaped recovery is it's very similar to what happened last year. Last year was just a much more extreme example of the recent move we've had, right? So if you look at this year versus last year, man, it's almost scary how much it lines up. Now, do keep in mind we had an initial big V recovery there and then a big downfall again, not to lower low though. That was an important thing. So if you're thinking about can the market continue to rally further from here, if the market does go down at all in the next few days, we just got to make sure we don't set a new lower low for this market. As long as we don't do that, we're pretty smooth sailing from here on out, right? And we'll just keep recovering. Next thing you know, we'll be talking about all-time highs for the market once again, right? Now, the next thing you got to ask yourself is, why was last year so much more extreme than this year, right? Like this downfall, it's just a much smaller version of this downfall, right? But why? Why was last year so extreme? Well, the reason last year was so extreme is it could have affected very negatively several different things. This situation with the Middle East country, I don't even know if I can use that word because of, I don't know the way, these AI programs work nowadays. Like, it's just ridiculous. But the bottom line is the situation in the Middle East, right? That could obviously spike oil prices, which could affect inflation, which could then make the Fed not lower as many times as you might think. It could potentially hurt the economy a little bit, but I mean, that's not like a huge factor, right? It's there, but it's not like, oh my gosh, like somebody has to spend an extra $40 a month on gas, like the whole economy's wrecked, right? We're not that fragile. We're fragile, but not that fragile, right? So that's matters, but it's not nearly as much as the tariff drama of last year. The tariff drama of last year, remember, ladies and gentlemen, right? We were talking about that was going to increase inflation potentially massively, right? Because if you're talking about companies have to pay a bunch of tariffs to the government, well, they're going to pass that along to the consumer eventually, and that's going to show up in inflation numbers, right? So we were worried about that. Then additionally, you're worried about supply chain mess because if, let's say, Trump back in April of last year was talking about like 100% plus tariffs on China. I mean, that basically makes it so it doesn't matter what you're making in China, you have to move it to another country at that particular time we were thinking about, right? So that makes for supply chains to be a complete mess. That creates potentially even problems with inflation again, right? Because last time we had supply chain mess was obviously coming out of Rona, right? And then, you could look at it as just as a big business tax, right? A big tax on corporations, which all is very negative for the stock market. So if you're wondering why it was so much more extreme what we went through last year than this year, it's because it affected so many more things, and that ultimately could send the stock market down much, much lower, right? Now, here's the deal, okay? Listen. In regards to the ceasefire situation, who knows what's going to happen here, right? U.S. has violated ceasefire agreement according to that Middle Eastern country there, right? So it seems to be going great. It seems to be going just great, right? We'll see what happens with this. I'm not going to get too excited. When I saw the news come out last night, I was like, I didn't do some breaking news video on it or something. I was like, whatever. Like, we'll see how this goes, right? But the important thing you got to understand about the stock market from the stock market perspective, and like why the stock market starts to move up so substantially and bottoms and starts to form like a V-shaped recovery, is if I take you back to last year's tariff drama, for instance, right? There was basically an increase. It was like increasingly getting more scary, the tariff drama. And the peak of the scare was April 9th. Okay, that was the peak, most scary part, and the market bottom right around that April 9th, April 11th timeframe. I think it was actually April 9th or April 7th, somewhere around there, the stock market bottom, right? And that was peak scariness at that particular time, right? So stock market bottoms there and then starts heading up. Now, did that mean the tariff mess was done? Absolutely not. We still had huge problems with the tariff situation for quite some time, right? Like, that didn't clear up things. Like, we still had more drama over future months, right? But that was the peak scariness part, right? And then things started to slowly get less bad. Now, this is a very similar phenomenon to what we just occurred with this whole situation in the Middle East, right? Okay, Trump was talking about, wrecking their civilization, right? Sending them back to the Stone Ages, right? The Middle Eastern country is talking about taking out a ton of oil facilities around the region. That's peak scariness. It doesn't get any scarier than that. Talking about wiping out civilizations, that's the peak, okay? So now everything that happens from here is less scary than we're wiping out civilizations and, this country threatening to, wipe out oil facilities across that whole region, right? That's peak scariness. So now any issues that arise, it's less scary than wiping out civilizations because that you already took it to the most extreme. You could it's nothing that's more extreme than taking out civilizations. Okay, that's it. So now, how do you get the market to freak out? It's tough because you already took it so crazy, and that's why the market has already bottomed now and it has forming a massive V-shaped recovery now at this point in time. It's very important everybody understands that, right? Things are getting less bad now at this point in time, right? Now, this also is very important for everybody watching this right now. This is why you do weekly buys or you do bi-weekly buys in your portfolio, essentially, right? You don't want to worry about timing it perfectly as far as the market goes, right? So many people are playing this game about trying to time it out perfectly, and I'm going to sell the stocks because this is going to go so bad, and we got lower to go, and all this mumbo jumbo, right? Worry about buying consistently in your portfolios, regardless of, if you think the NASDAQ's going down 20% or 50% or 900%, it can't go down that much, 99%, whatever your little theory is, okay? Bless your soul for your little theory about where you think the NASDAQ's going, right? You have no clue. I have no clue. I've been doing this for 17 plus years. I'm in the market every single day, right? Every single day. Got a lot of money invested. And I can't tell you, where the NASDAQ's next 1,000 points is. Who knows? Something goes bad tomorrow. Okay, NASDAQ goes down 1,000 points. Who knows? I can tell you where the next 20,000 points is for the NASDAQ, though. And it's a lot higher, right? Worry about buying each week or every 2 weeks and not trying to perfectly time this thing, right? The bottom line is you should have been buying last week. The NASDAQ was down 13% plus from all-time highs. How often do you get the NASDAQ down 13% plus from all-time highs? Once every maybe 2 years? Something like that? Take advantage. Don't sit on your hands. Take advantage. NASDAQ's down 13% and you got good deals all over the place. You better be buying. The VIX was 30 plus. You got to be buying, right? The fear gauge, the fear ingredient index, that was in extreme fear, and not just a little bit in extreme fear, deep into extreme fear. Now you can say, well, but last year the NASDAQ went down a little over 20%. We only were down 13%, so I shouldn't have been buying, right? And last year the VIX spiked to 60, and last year the extreme fear gauge got even more in extreme fear. Dude, not every year is the same. And what has been going on this year is not nearly as scary for the stock market as what occurred last year. So you can't assume last year, that's not how it works. That's the same game people have been playing since the great financial crisis. Every time the market drops since the great financial crisis, listen, people are like, it's going to get worse because it's going to go down 50%. We're going to have 50% crash, right? I've heard this continuously since I got in the market during the great financial crisis. Because the market went down 50% in the great financial crisis, then everybody started assuming that's what happens every time the market goes down. Oh, it's going to go down 50%. It hasn't. You've had so many insane things happen all these years since that occurred, right? And yet, how many times does the stock market go down 50% since then? It hasn't. During Rona, during all this craziness we've had over the last 17 years, and it still hasn't, right? And you've had the Fed reduce balance sheet, increase balance sheet. You've had the Fed flood the market with money. You've had to pull back. You've had a million different things. You've had all different types of presidents come and go. And at the end of the day, we went higher, right? And we never had that 50% crash. So you can't assume, something happened this way last year, so I got to wait for that to happen. You're crazy. You could have said that last year, and you're like last year, for instance, NASDAQ goes down 20+%. You could have been saying, well, in 2022, NASDAQ peak to trough went down 37%. So I got to wait for 35%, 37%. We can play these games of in the past, it went. Dude, you're going to produce very abysmal returns over time. Very abysmal returns if you play that whole game of this happened in the past and this is going to happen this year, so I can't buy. No. Okay. Focus on buying every single week or at least every 2 weeks. A comment that really bugs me sometimes I'll see is I'm out of money. Go get some money. Go get some money. We don't have time to be out of money. We got to go get some money. You need to be in a position where you have more income than expenses, so you can consistently buy out there in the market, right? There should be no such thing as you're out of money unless you're out of money for the day or you're out of money for the week. But at least every 2 weeks, you need to be buying your portfolios. I did that when I used to work for $8 an hour back in the day. I did that when I was working at Quick Trip. At least every 2 weeks, I was coming in ready to buy. That's how it's got to be, man. At least every 2 weeks, you've got to be ready to come in with buys, right? This is the past 20 years for the NASDAQ. Every single time it's in a correction or a crash, they say it's going to get worse. Don't buy yet. It's going to get worse. It has never occurred where people said, yes, go out there and buy. Never. It's always, it's going to get worse. It's ugly out there. It's going to get worse. It's going to get worse. It's going to get worse. The great financial crisis, the NASDAQ was down 50%. It still wasn't good enough for a lot of people. They were talking about it's going a lot lower. There's a ton of articles you can search out there from that particular time and find that people were still talking about, in old interviews and things like that, it's going lower, right? And then we had double dip recession fears and all that. It's going lower. We had this situation kind of in the summer of 2015. It's going lower, right? 2018, it's going lower. The Rona crash, it's going lower. 2022, it's going lower. I mean, 2022, like I said, the Q4 2021 peak to the Q4 2022 trough, 37% down, it still wasn't good enough for some people. Like, it still wasn't good enough. My gosh, you were getting the greatest tech companies in the world at ridiculous discounts. It still wasn't good enough, right? We had, obviously, Liberation Day. That wasn't good enough for some people. Oh, it's going to get worse, right? And then this situation, it's going to get worse. It's always going to get worse, right? And yet, you just keep missing money. You just keep missing money, right? Now, look at this. Oh my gosh. The NASDAQ is already up over 9 percentage points from where it was less than 2 weeks ago. Less than 2 weeks ago, ladies and gentlemen. So it's basically giving you a year's worth of returns in less than 2 weeks, just coming off that bottom, right? That's how quick things shift in the stock market. Incredible. Absolutely incredible. That's just crazy. Like, you think about the S&P 500, when you get in the stock market, you start learning about money, you kind of learn about the S&P 500, and it's like, well, if you buy the S&P 500, you probably make like 8% a year, roughly somewhere around there, right? And the NASDAQ just gave you 9% less than 2 weeks. In less than 2 weeks. Jeez, right? You ever heard of this? It's called the KISS method, the KISS principle, right? Keep it simple, stupid. Most systems work best if they kept simple rather than making them complicated. And this is what happens in the stock market. People try to overcomplicate these things. They going to try to buy at the very perfect time, and 13% down for the NASDAQ's not good enough. I need it down 23%. I need it down 18%. I need it down like 400%. Bottom line, ladies and gentlemen, keep it simple, stupid. You see great deals, go buy the great deals. Don't focus on, I might go another 5% lower or 3%. No, keep it simple. This stock is insanely undervalued. I'm going to buy that stock. I'm going to hold that stock for the next several years. And do you know what you do if a month later that stock is at a much lower price than what you bought at, and you still love the fundamentals of the company, you still believe in its trajectory over the next 3, 5, 7, 10 years? You buy more shares. You buy more shares. You say, I'm out of money. No, you're not. Go get some money. More income than expenses. Just keep it simple. We don't have to overcomplicate this game. Keep it simple. More income than expenses. Buy consistently. The more damage out there in the market, the heavier you buy, right? Don't mess around with margin. Look at your PE ratios. Run your valuations on these companies over the coming years. Learn about income statements, balance sheets. Keep the game simple. The simpler, probably the better returns you're going to get. The more complicated you try to get this stuff, you got to ask yourself, why are the most intelligent individuals in the world not the richest, right? Why are the most intelligent fund managers not the richest? If you've heard a lot of the most successful fund managers in the world talk over time, right? Peter Lynch, I don't care if Peter Lynch, Warren Buffett, all these guys, Stanley Druckenmiller, all these guys that are legends in regards to getting insane returns over time. None of these guys you would expect to be the highest IQ individuals you ever met. Oh my gosh, they're super geniuses, right? They're highly respected because they're insanely rich, and highly respected because their returns are unbelievable. But it's not because they developed some crazy calculus of we're going to do this and do that. No, they kept it very, very simple. And when prices got very attractive on great businesses, they picked up those businesses. And they did that across many assets over many years, and they produced unbelievable returns for themselves, right? And, look at myself. Am I the smartest guy out there? Heck no. Heck no. I'm just another individual. I understand business pretty well, and I understand investing pretty well, right? And I understand human psychology pretty decent. But I'm not some super genius. Put me in some advanced math class, I'm not going to do well. Put me in any advanced subject other than money-related subjects, am I going to do well? Absolutely not. But I keep it very simple. I've done pretty darn well for myself over the years, have I not? Right? We got to do this, man. We got to keep it simple. Don't try to overcomplicate this game. What's going to produce you really bad returns over time. Okay. Alrighty, before we get into this next subject, which is what is wrong with party pooper stocks like Palantir, Salesforce, things like that, how much cash I have, and what new stock I'm most likely to buy, I want to let you guys know. Free workshop, pinned comment down there. Did I already let you know that? See, I told you. Am I that intelligent? Didn't I already let you guys know this earlier in the video about the free workshop? Yes, right there. Proof. Like, I can't even get my own dang workshop call to action right? There you go. Okay. Alrighty. So next up here, let's talk about Palantir. So Palantir, from its all-time high, it hit set back in Q4 2025. Stock's down about 32% roughly. The Qs are down about 4% since then. S&P 500 is down 1%, right? So there's clearly an issue with Palantir's stock price. Now, it's not really an issue with the business model, right? Numbers are great. But there's clearly an issue with the stock price of the company, right? Now, we have a lot of different issues that are going on here with Palantir and why the stock's a party pooper right now, right? NHS data chief pushes for deeper rollout of Palantir technology despite outcry, right? Palantir's got a bit of and it's gonna get worse before it gets better. They have a big problem on their hands in regards to surveillance, right? And being Palantir, for right or for wrong, is going to definitely be seen as a public enemy when it comes to surveillance, when it comes to ICE and what they're up to, right? Homeland Security and surveilling of potentially citizens of the United States, right? Now, it's all supposed to be for a greater good of like keeping Americans safe, but at the end of the day, you try to play this game, you're taking away freedoms, right? For instance, if I take you back to 9/11, right? Obviously out of 9/11 came a lot of different changes and we got stripped of a lot of different freedoms, right? And now all of a sudden we got to get patted down every time we go to the airport, right? We got to do this, we got to do that, right? And so your freedoms in terms of like, we're going to try to keep Americans safe, your freedoms, get eroded, your privacy gets eroded as the years tick on, right? And as the decades tick on. And so there's a very strong argument to be made that Americans today are the less free by far Americans have ever been, ever. You know what I mean? Like in terms of the government being able to surveil you and know everything about you, I mean, there's never been a better time for the government to know every single thing you're up to, every single thing you're doing, right? And so Palantir can definitely be positioned as public enemy number one, right? In regards to this subject. You ever seen a movie called Enemy of the State? That's a great movie from back in the day. Gene Hackman, Will Smith. I think that was a movie that definitely opened some folks' eyes on the government, keeping, track of a lot of different things, right? And it's crazy to think that that movie's probably almost 3 decades old now at this point in time. Imagine the technology they have nowadays, right? So that's an issue, and that's not going to clear up in the short term, right? And around election time, it could get worse for Palantir in regards to this, right? Now, additionally, you have this starting to come out, right? They're starting to become fear around Palantir's future growth rates because of a company named Anthropic. Michael Burry, everybody knows from The Big Short, Michael Burry warns Palantir will likely lose enterprise market to Anthropic. Anthropic now accounts for nearly 73% of new enterprise AI spending. Driven by cost-effective, scalable solutions, Palantir focuses on complex government contracts, whereas Anthropic dominates corporate adoption. Anthropic experience, and keep in mind, Palantir has been growing phenomenally in the corporate area as well. Like that's been their fastest growth actually outside of the government. Anthropic experienced its fastest user growth ever in February, with adoption rising by almost 5 percentage points in just 1 month. The Big Short investor Michael Burry, known for predicting the 2008 financial crisis, oh gosh, it's going to be like year 2039 and they're still going to be talking about that, has raised concerns over Palantir Technologies as he praised the rapid growth of Anthropic, the AI startup that has captured the attention of enterprise clients. In a post on X, you want to follow me on X? I always have it linked in the description area down there. That's been popping my X page. Burry suggests that Anthropic's surge has considerably outpaced Palantir in terms of revenue expansion and market relevance. Okay. According to Burry, Anthropic's annual recurring revenue, ARR, skyrocketed from 9 billion to 30 billion within just months, driven by its cost-effective, user-friendly AI solutions. In contrast, Palantir, which has traditionally focused on government contracts and high complexity deployments, achieved $5 billion in annual recurring revenue over 20 years. Burry highlighted that Anthropic now captures nearly 73% of new enterprise AI spending, underscoring a rapid shift toward more intuitive business applications, whereas Palantir's government-centric business model offers on lower margin returns. Anthropic has targeted enterprise clients with scalable solutions that are easier to implement and less costly. This approach has enabled the startup to dominate corporate adoption and siphon market share. So in regards to companies like Anthropic and all these others that are competing in these spaces, they absolutely need to be taken seriously, right? But there is this overwhelming amount of fear about all these other companies, in that if you're not ChatGPT or you're not Anthropic, like, you're irrelevant, right? They're going to take everything. And I just don't see it that way. Even Jensen doesn't see it that way over there at NVIDIA. I don't want to call it a naive perspective, but it's a perspective that is based more on fear than I feel like excitement about these other companies. It's more like they're going to eat up everything, right? And so, like, I mean, is it possible that some companies use Anthropic and then they decide, like, this is good enough for us, we don't ever need Palantir's products? Sure, that's possible, right? And that's a risk you have to be willing to take if you own Palantir stock or you want to buy Palantir stock, right? But we're in a time period where things just aren't known about how this fight will go really long term, and people are just more scared than anything, right? But I'll show you the main issue with Palantir. This is the main issue with Palantir stock, right? What I'm showing you right now. Palantir over the next several quarters is going to have revenue growth deceleration. This is the most significant thing and the one thing that's really holding back Palantir stock, right? This is the one big thing. At the end of the day, the Palantir's revenue growth is expected to decelerate quarter after quarter after quarter for a while, right? And that's an issue. And so what did I tell you guys last year in regards to Palantir? I said this will be a range-bound stock for a while. This will be a range-bound stock for a while. This will, I told you guys last year, I think the stock is stuck between 125 and 200, right? And one reason was the valuation went so high. The other reason is a lot of growth investors just don't want to buy into a stock that has decelerating revenue growth, right? And this is going to compound bigger in more of a negative fashion as you get people like Burry to be out there on social media talking about Anthropic's going to eat Palantir's lunch over time, right? Because then people are going to see Palantir's revenue growth decelerating, right? Not going up as fast as it was going up. It's like, oh, Palantir was growing revenue at 70-something%. Now they're growing at 60. Now they're growing at 50. Now they're growing at 40, right? And then people are going to feel like there's some sort of like justification of like, yeah, Anthropic is eating their lunch or other companies are eating their lunch, right? And it's like, no, just like you can't maintain 70% growth rates forever. No different than Anthropic's growth rates are ridiculous right now. Is Anthropic going to be still having those sorts of growth rates 5 years from now? Highly, highly doubt it. 10 years from now? Highly doubt it, right? Like, it's just, the numbers start to really add up, and then it's hard to have the same, like, you can look at every company throughout history. That's how it happens. One moment your revenue is growing at 10,000%. Next thing is growing 1,000%. And then it's growing hundreds of percent. And then it's growing 50%. And then it's growing 20%. And then if you're lucky, you can maintain a 15 to 25% revenue growth for a long time to go in the future. And if you have a not such a well-run company, your revenue growth starts to go down over time, and then all of a sudden, it starts to go negative, and then, eventually you go to bankruptcy, which is, where do most companies end long term? It's important everybody understands this about a business cycle of a company. Where do most companies end long term? Let me ask you that. Bankruptcy or getting bought by another company? And ultimately, that product, service, business becomes irrelevant long term. That's all companies do die. I don't think people understand that, because a lot of times, like, whatever the big company was when you were like a little kid or when you were just born is still the big company, right? Apple, Microsoft, Amazon, all those companies are going to die one day. Maybe not in our lifetime, but they will all die one day, as every single company always does. Just like we can't live forever as humans, companies can't live forever either. They will all die one day, right? They're going to either just go to bankruptcy or they're going to get bought out by another company, absorbed by another company, and then slowly just kind of like becomes irrelevant inside that other big company over time. It's a cycle of life. It's a cycle of business. If you run a really great business, it might be able to stay around for 3 or 4 generations, right? And that's a really special business, really special. Other than that, bankruptcy, or you're getting absorbed by another company over time, right? So anyways, I think I went a little off subject there, but that's the issue with Palantir is decelerating growth rates. This is a much more significant thing, right? What about a stock like Salesforce? I mean, look at the stock, down 33% year to date. It just can't catch a break. I mean, it's brutal. Look at ServiceNow. ServiceNow's down to 97, 36% down year to date. It's unbelievable with these stocks, right? Look at the IGV today. The IGV is the software ETF. It's dead. Like, they went down today. The market was up 1 trillion%, and the IGV was still down. If you cannot go up on a day like today, when do you ever have a chance? The NASDAQ was up close to 3% today. The Dow was up, 1,200, 1,300 points, something ridiculous. And the IGV was still down 1%. I mean, you're dead. You're dead. Brutal. Absolutely brutal. And so IGV down 15% it's only up 15% the past 5 years. Like, that's almost like shocking. Like, the whole software ETF only up 15% the past 5 years. Crazy. So here's what I'll tell you guys, and this happens in the stock market sometimes, okay? So sometimes the market is in like a no-touch situation. And that's where these SaaS stocks are right now. It doesn't matter how far down they are. It doesn't matter if the stock is down 50% from its all-time high, 60%, 70%, 99%. Fund managers refuse to touch these stocks in the short term. Refuse to. It doesn't matter the price to sales ratio. It doesn't matter the PE ratio. It doesn't matter the DCF model. In the very short term, Wall Street refuses to touch these stocks, okay? And so that's just a moment in time we're in right now. Like, sometimes that happens with the stock or a whole basket of stocks, and that's software stocks right now. And they refuse. They're just, nope. They'll sell, but they're not. Also, you got to understand, all the software stocks are going from one investor class to another. Let me explain this deeper, because no one's going to explain to you this type of stuff we're explaining here 32 minutes deep in this video. No one's going to explain this, okay? I have CNBC on constantly in the background when I'm working in Bloomberg. No one's going to explain what I'm about to explain to you. You have a handoff of stocks from growth investors to value investors that occurs over time, okay? Software stocks are going through this moment in time right now, and it's a brutal time for the stock price. And what happens is growth investors sell out because they start to become not convinced these companies are going to have great growth rates anymore, which is certainly what they've become because of ChatGPT, because of Anthropic and Claude and these different models. So they think like, no, that's not happening. These companies, they cannot have great growth anymore. That they've become convinced that they're not going to have great growth. Maybe they'll grow their revenues 5, 10, 15%, but they're not going to have those 20% plus growth rates ever again, right? That's like a consensus around. Like, I don't care if you're talking Salesforce, ServiceNow, Adobe, Intuit, throw the whole list of them. Wall Street is convinced those companies will never have 20% type growth rates ever again. They'll be stuck in 5 to maybe 15% for the rest of their company's lives, right? So it means growth investors like, we're out. We don't want it anymore. So then there's a handoff. And that's when value investors start to step in. So myself, I'm a part growth investor. I'm a part value investor, right? My value side is what has gotten very interested in SaaS stocks, which is why I've started buying a lot of SaaS stocks over the past few months, right? Because I'm looking at the valuation. I'm like, oh my gosh, this company still is going to be a growing company. Yeah, maybe they don't grow at 20% clip, but they might grow at 7%. And then if they're at this sort of PE with these sorts of margins, like, we got to buy here. We got a deal. And so then value investors slowly step in. But value investors don't just go buy right away. Value investors have never, ever had a chance to buy these sorts of stocks. So value investors have really just started to look at these opportunities really in the last couple months here. Salesforce, Adobe, Intuit, ServiceNow, go through the whole list of them, right? They're just starting to kind of look into these stocks, and that's a long process. And so then a certain amount of them will say, no, I still don't want. Others will say, you know what? I'm going to start buying these, right? And they'll buy more and more and more, and that's with the handoff. This has happened with every stock throughout history. Even a great stock like Apple went through this. Apple used to be a very high growth company, and then everybody became convinced basically Apple's not going to grow at that 20% plus clip anymore. Like that was, that time period died, right? And then Apple stock went through a brutal time. Stock price got hammered. It was down and out for like at least a couple of years. And this was after there was like several years of the initial iPhone cycle. Growth investors said, we're done with Apple. Apple stock sucked for a while there, right? And then I think this was like after the iPhone 5 cycle, if I recall, right? And so then who steps in? Value investors slowly start to step in. The number one value investor, the most famous value investor in the history of the world is who? Mr. Warren Buffett. Even Warren Buffett stepped in and bought Apple stock heavy. My gosh, Warren Buffett, right? But that's what it takes, right? And so right now we're in a transition period. All these stocks, the growth investors basically have sold off. They say, we don't want a piece of these anymore, right? And now value investors are looking into these companies and they'll start to slowly nibble and nibble and nibble and they'll buy, right? And I think most of these stocks are going to be fine for the next 5-10 years. I think a lot of them are going to perform very well. And I think value investors will make a lot of money in many of these stocks. Not all of them. Some of them will be replaced. But a lot of them, value investors are going to make very good money. Probably way above market returns over the next 5, 7, 10 years. And happy times. But it's an awkward transition to go through. It's an awkward transition, but it has, you got to understand what I'm talking about here. It does occur when you get that handoff from growth investors to value investors, right? Now, Benioff, he talked about this last quarter. This isn't the company's first SaaS apocalypse, right? Companies like Salesforce and all these other companies in this space, listen, man, it doesn't matter really the story they tell. They're going to try to tell stories about, we're ready for AI and this and that. The market's not buying it. The number one thing these companies can do over the next 4 quarters is put up great numbers. Just keep putting up great numbers. Keep showing growth. Keep coming in with beats. And eventually the market narrative will change on these stocks. And they'll just give up. They'll be like, yeah, dude, how many times are we going to say these stocks are done? How many times are we going to say, Anthropic's going to wipe them out and ChatGPT's going to wipe them out and blah, 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 right? As long as they just keep coming in with the numbers, that's all that matters. And then more and more value investors will feel comfortable because value investors are going to say, how many years are we into this AI cycle and these companies are still reporting great numbers? Like, what are we going to wait, another 10 years? Like, these companies are putting up great numbers quarter in, quarter out. Their customers continue to use their products. And that's going to be that. So, that's all these companies got to keep doing. Keep coming in with the good numbers, and eventually the market narrative will shift in regards to all these SaaS stocks, and the value investors will love them. And then they'll price these stocks. What will happen with the price of these stocks as far as forward Ps? And once again, you're not going to hear anybody else talk about this on Bloomberg, CNBC, anywhere. What's going to happen with the P ratios of these stocks is they're going to go up quite a bit from where they're at right now. With that being said, these companies will never command the forward Ps, the 2-year forward Ps, and the trailing 12-month Ps that they used to command a couple years ago, okay? So there's going to be like this happy medium. Right now, the P ratios, all these stocks is like down and out. I mean, Salesforce probably trades at a forward P right now of, I would say 12 or 13, somewhere in there. That's ridiculous. Like, come on, really? Adobe's at a forward P of probably like 9 right now. Even ServiceNow, which is a company that's probably going to grow right around 20% or just under 20% top line, bottom line for years to go in the future. Even ServiceNow is now trading at a forward P of like 22. Come on. Like we're way too low on these companies, especially because these are some of the best business models in the creation of mankind, right? Like, come on. So you're going to get a P ratio and a trailing 12 P ratio that will happen over the next year that's going to be higher than where we're at right now, but don't expect the old P. Like if ServiceNow used to trade at a forward P of 70, which that wasn't crazy for ServiceNow in the past, don't expect that moving forward. However, could it trade at a forward P in the 30s with these sorts of growth rates it has? Sure, that's very possible. Salesforce used to command a forward P at 25, 30. I don't think Salesforce is going back to a forward P at 25, 30. But should it be at a forward P at 12? No, that's silly. 18 to 20? Pretty fair. So you'll get a nice valuation lift on these companies, in my opinion, over the next year or two. Just don't expect them to go back to the old valuations of PE ratios, forward Ps, things like that. Okay. Alrighty, next subject up here. How low am I in cash? And then what's the new stock I'm most likely to buy? Well, okay, so here's one of my accounts. Bank account, $826,000 I have there. I probably need to move some of that money into high yield savings. So high yield savings, I have a little less than $1 million right now. So I have quite a bit of money chilling, right? I bought a lot of stocks pretty heavily, but I'm ready, send the market down more and I'm ready for it, right? I'm in a really great position regardless. Like if the market were to go down a ton more and set new lows, right? Which I think is a tough debate to make now. NASDAQ's up 9% from those lows it hit a couple weeks ago. To get the NASDAQ to go to new lower lows, that's going to be difficult. It's possible, but very difficult, right? And so if that does happen, I'm in a good position. I got a lot of money still to buy with, right? If it doesn't happen, that's okay, because I bought stocks very heavily the last month or two, right? There's been some crazy buy days where I put in, large amounts of money, like $60,000 in a day or $70,000, things like that, right? So I'm in a strong position regardless of what happens here, right? Also, do keep in mind, I don't see myself ever going under $1 million of money sitting around outside of like a great financial crisis, like an epic, insane stock market crash where the market goes down like 50%. It's just something ridiculous, right? I don't see myself going under 1 mil. I think moving forward, I'll always keep more than 1 million just sitting around. It just, helps you sleep well at night, right? And so that's kind of where I'm at with cash levels. I deployed a lot, but I still got a lot just in case. We'll see what happens, right? I never get too excited about whatever's going on in the stock market in the short term. Next up here, what's new stock am I most likely to buy? Well, last night on the channel, I came out with this video about 24 hours ago. Top 10 stocks to buy under $100. You guys might want to check that one out so far. It looks like about 62,000 people have gotten to see it so far. Definitely a good video. I actually go into price targets with that video as well. Like price targets, bull cases, bear cases, base cases for these stocks over the next 3 years. So might be a video you want to check out there, right? But that was posted on the channel last night. As far as stock I'm most likely to buy, this actually might surprise some people. Bath & Body Works. Bath & Body Works, this stock's down about 64% the past 5 years. Very simple business. They sell candles and soaps and lotions and all those sorts of things. $17 stock. This one I'm most likely to buy if I'm going to buy a new stock, right? Now, keep in mind, I'm adding to existing positions right now, but if I'm going to start a new position, this is actually my favorite. Forward P on the stock is about 7. Big dividend yield on this one, and extremely profitable business. I love it, man. I love this stock. In terms of the price it's at right now. I mean, if this was a $40 stock today, no, I would not be interested. At 17, it's a whole different situation, right? Another stock I'm pretty interested in is RH, $120 stock. This stock's down 80% the past 5 years. Talk about a brutal past 5 years for a stock, right? But this one I'm keeping a close eye on here. This one's a tough one for me because it's hard to get bullish on high-end real estate in the short term, but keep in mind these stocks always bottom. They always bottom way before the market itself, or basically before the high-end housing market is going to be great again. Like RH is going to already be up huge from then, right? So I don't know, man. It's one I'm definitely considering, right? Now, you got to understand, we are about to start earnings season. Earnings season starts here in a few days from now. So the market is going to shift from geopolitics, from inflation, from the Fed. That doesn't mean it won't be talked about at all, but it's going to slowly start to shift about a week from now to earnings season. And suddenly everybody's going to be talking about NVIDIA's numbers, Meta's numbers, AMD's numbers, which I love. I love to talk companies. Now, keep in mind what happened last earnings season. There was a lot of fear going into it because of the tariff drama. Companies came in and said it's not as scary as y'all are making it out to be. And market started to head up even to a greater extent from there. That could happen this year. Don't get your hopes up, but that could happen where, everybody's freaking out and then you see companies' numbers and it's like, everything looks pretty good. And then it's like, oh, I guess we got a little too crazy about this, right? We'll see. We'll see what happens with here. But yeah, earnings season is about to get rolling, so just get ready, guys. It's about to be busy times ahead, okay? If you want to follow me on X or you want to follow me on Instagram, I have that linked in the description area down there. And once again, that free workshop will be the pinned comment down there, how to manage your portfolio at every stage. Build, scale, and protect your portfolio to avoid mistakes that will destroy your long-term returns. Look at the public count. That's the best example of this, right? Huge ups and huge downs throughout the past 3 years. Public count, if we go back 3 years ago, was about a $1.2, $1.3 million portfolio. Today it's $3.3 million. It has gained over $2 million of value just the past 3 years. If I think about in total, probably up $7 million plus the past 3 years. Millions of flapjacks were made over the past 3 years, and it has been crazy. And folks, it will stay crazy for quite a while. I got to go through 10 stocks, my top 10 stocks to buy right now, under $100 a share. So every single stock in this video is under $100 a share. Some of these stocks are way under $100 a share. And all these stocks, in my opinion, have incredible upside potential over the next 3 years. Now, additionally, in today's video, the other exciting thing we're going to do in today's video is I'm going to give you my price targets on these stocks as well. Now, we're going to go through these stocks rapid fire. I don't want to spend 6 hours doing this video here today since we have so many stocks to cover. So we're going to try to do it rapid fire, and we'll cover the companies quickly, and I'm going to give you my price targets for these companies. So I hope you guys really enjoy this. I've been prepping this video all day for you guys. One thing and one thing only I need from you. If you could please just take a second and smash that like button. Hit that little thumbs up icon. That's all I need from you guys. I hope you appreciate me doing this video for you guys, sharing these 10 stocks with you, the price targets and all that. And all I needed is that little like button hit. Okay. Also, make sure you're subscribed here to the channel. If you're not subscribed, it is free to do so. And it looks like about 25%, so about a quarter of the people that watch my channel on a daily basis are not even subscribed to the channel. So make sure you subscribe to the channel also, ladies and gentlemen. Okay. All right. We got a lot to go through, so let's just start going right through it. Number one of these 10 stocks that is a buy right now, it's under $100, is Celsius Holdings. Ticker symbol on this one is CELH. This is an energy drink company. I mean, I would say probably the far majority of people watching this video, even if you don't drink energy drinks, you've heard of Celsius energy drink. It's gotten that popular over the past 5 years, right? They also now own Alani, which is an energy drink brand that has been blowing up the past 3 years specifically. They also now own Rockstar Energy, which they just acquired from PepsiCo. Rockstar Energy was acquired by Pepsi many years ago, kind of ran into the ground, hasn't done anything. And Celsius might bring that brand also back to life over the next several years, right? The thing with Celsius that makes the stock very attractive right now is a forward P, and keep in mind it's a $34 stock right now. The forward P on the stock is 20, right? 20 forward P for Celsius, a company that should grow top line, bottom line, double-digit clip for years to go in the future, regardless of the economy, good economy, bad economy, so-so economy. Celsius should put up their numbers, double-digit growth year in and year out for years to go in the future, right? Now, Celsius, if we look at the revenue on a trailing 12-month basis, this is where we're at right now. This is where we're expected to go. The red line, we're looking at 1000xstocks.com right now. The red line is like bearish assumptions from analysts. The gold line there is the average, right? Kind of the median there. And then the green is if things go really well for Celsius, this is where their revenue is going to trend. So even in a bear scenario, their revenue is still going to go up considerably from here. That's what you want to see in an energy drink company like Celsius and in a company in general, right? Gross margins have been actually slightly uptrending over the past few years. I think you're going to have a major increase over the next, we can call it 2 or 3 years in regards to gross margins, net margins, especially now that they've got the deals done. I don't think Celsius needs to acquire anybody else for quite a while. They're going to have their hands full between the distribution, the Celsius brand continued around the United States and international, and then the Alani brand and the distribution of that. Obviously with the Pepsi network now, they're in with Pepsi very close. Pepsi's now a big investor in Celsius, okay? This is earnings per share. This is where we're at right now on a 12-month basis. This is where we're expected to go over the next few quarters, ladies and gentlemen. Watch that earnings per share boom over the next several years, but especially just over the next year alone, right? Now, free cash flow, also the company, you will see that go up considerably now all the acquisitions are done and they got all the termination expense. They got a bunch of stuff done now at this point in time. So that sets up earnings per share, free cash flow, all those sorts of things in a major way. Operating income of the company is going to have a huge comeback now. Once again, the Alani deal, the Rockstar deal is done. Watch for operating income to increase considerably, not only this year in 2026, but over future years as well. Shareholder equity continues to climb for the company as cash begins to really pour into this company. That shareholder equity should continue to increase. Keep in mind, they could do big buybacks over the next couple of years here. And the reason being is I don't think they're going to acquire any other energy drink brands for years because they're going to have their hands full with the brands they have. And then additionally, like, if you look at the share price right now, I mean, this was a stock that was $100 a share a few years ago, right? So being that it's down here at these prices, the company should try to buy back every share in sight over the next, I would say, 12 to 24 months here, right? Now, what are my price targets for Celsius? So keep in mind the stock right now is a $34 stock. Bear case on this, I have it at $45. So even under a bear case, as when things go much worse than I anticipate, I still have the stock appreciating quite considerably. That would still likely outperform the S&P 500 over the next 3 years, or at least be in line, right? Even under a bear assumption. My base case, this is just a fancy way of saying what I actually expect. I expect Celsius to be somewhere in the $75 range 3 years from now. My bull case has them going to new all-time highs, which would be $100+ over the next 3 years. This picture is courtesy of my new house. So I'm actually going over there after I release this video here today and go check things out and all that good stuff. The house is done, but we got a lot of projects going on. We're going to move in likely next month. Okay. Stock number 2 of these 10 stocks up here today is Elf on a shelf. Elf Beauty Cosmetics Company is a $3.7 billion market cap here today. $60 stock. Oh my gosh, this one's trading way too cheap. It's trading at a forward P of 18. Come on. Elf has double-digit top-line, bottom-line growth to go for years to go in the future. We're talking all the way into the 2030s. And so the fact that Elf is trading at a forward P under 20 right now is just laughable. Simply laughable, right? Now, in the short term, you never know what could happen with these stocks, right? You look at a stock like Elf today, it's $60. If the stock market crashes, who knows, it can go down to 40, right? The market can be crazy. This is a ridiculous price Elf's trading at, but doesn't mean it can't get more ridiculous. Last year, Elf went to $49 a share. $49 a share. This is silly. There's no other way to put it. Silly pricing, but you never know what can happen in the short term in regards to stock prices. The moral of the story is Elf has a lot of runway over the next few years for the stock to go up considerably, right? The thing you got to understand about Elf that makes this, because you hear about it, okay, it's a cosmetics company, beauty company. A few things you got to understand. One, they acquired Rhode Beauty, which is a brand owned by was owned by Hailey Bieber. And that brand is insanely successful and continues to boom across the United States. And they're going to go and, expand that in a major way, likely international as well. Additionally, their products, right? The Naturium brand is also very successful. Elf also owns, right? In the body wash area. Now, the other thing with Elf, their products are usually priced at very attractive price points. They're not trying to go super high end or something like that. And so they're known for great quality products at low prices. This is a revenue on a trailing 12-month basis for Elf. This is where we're at right now. This is where we're expected to go here for Elf. Great gross margins, even with the tariff drama and all that. Net margins are going to explode for this company over the next 12 to 24 months. This is another one that is Elf buying any other brands over the next, 2 or 3 years? I don't think so. All things are possible, but I just think they're going to have their hands so full with Elf, with Rhode, with Naturium, that I think this next couple years here, they're just going to be busy. So unless there's companies trading at dirt cheap, ridiculous prices, I don't think they're buying anybody out, which means, ultimately their balance sheet should boom with cash, unless they, of course, do big share buybacks and spend that cash on that, right? This is where earnings per share is on a trailing 12-month basis, where earnings per share is expected to go over the next year. Free cash flow companies continue to explode. You haven't seen anything yet. Just watch that free cash flow over the next 12 to 24 months. Free cash flow per share, this is where we're at on a trailing 12-month basis there. Obviously up huge off the bottom. Historical PE, look, you're getting the stock at dirt cheap prices. Free cash flow better than ever. Free cash flow per share. I mean, revenues are booming. Exciting time for Elf. The margins are going to boom, and we're getting this stock for cheap prices, right? That's what you want to see. Operating cash flow of the company, this is where we're at on a trailing 12-month basis. Just watch where this goes over the next 12 to 24 months. Operating income, this is where we're at right now on a trailing 12-month basis, okay? Very exciting times for Elf, and to be an Elf shareholder. Stock price is what the stock price is in the short term, but if you have a longer term vision, this is the most exciting company you could invest into, in my opinion, by a mile in the beauty and cosmetic space. There's nothing even remotely close to Elf in terms of the long-term upside opportunity. And let's speak about that. This is my Elf 3-year price target. Keep in mind right now the stock's $60. My bear case is the stock is still $60 3 years from now. That would be a scenario where growth completely collapses for the company. And they maybe get a little margin left, a little profitability left, but ultimately revenue just isn't there. I think that's a very low probability, less than a 10% probability, but it is a possibility, right? My base case, fancy way of saying what I expect, I think the stock's going to be $140 stock or so 3 years from now. And then if things go much better than I anticipate, the stock will be over $200 and setting new all-time highs in the next 3 years. Keep in mind the all-time high for ELF stock is somewhere around, I think it's either 204 or 212, somewhere around there, okay? So long way to go there, okay? Before we get into number 3 of these 10 stocks, I want to let you know about the 2 pinned comments down there today. Number 1 pinned comment is access to my private stock group. If you want to apply for that, that's full access to all of my premium courses. Become a master of the stock market, millionaire playbook, stock options mastery, dividend investing mastery, my financial statements mastery, my valuation mastery, access to my private Discord chat, access to exclusive weekly videos, which I recorded my private group 2 videos just in the past week, exclusive videos for them, access to the moves I'm making, access to 1000xstocks.com. Man, it's just loaded. Plus, we send you your Steel membership cards when you join us in there. This is the private group card. This is a 2026 version that is actually a stock there. And then we send you your 1000X card. This is a 2024 edition. This is one that's a little old here. And if you join us on a lifetime basis, we will send you a lifetime membership card to your house. And then the second pinned comment down there today is going to be from my Instagram. If you want to follow me on Instagram, if you use Instagram, you can certainly follow me on there. That will be the second pinned comment down there today. Today I was talking about I'm on a 60-day challenge, trying to get a 6-pack. I'm doing 20 minutes of abs a day, and we'll see what happens. And so I was asking everybody's advice. So everybody was DMing me their ab advice and their ab workouts, okay? Alrighty guys, number 3 of these 10 stocks is SoFi Technologies, SOFI on this one. $16 stock here today, about a $20 billion market cap. Look at SoFi's revenues. Do you like it? Do you like it? Because I sure do, okay? Let me tell you where SoFi is headed over the next decade or so. SoFi is on the way to becoming a financial institutional giant. Giant. When you look at how many customers are acquiring, how they're able to sell their customers so many various products, right? Get them through the door and really attract the next several generations. SoFi sets themselves up to become a top 15 financial institution over the next decade or so. Anthony Noto just has to continue to manage the business in a great way. He's in the prime of his career right now. And if he manages business well over the next decade, they could become a top 15 biggest financial institution in the world, right? He's got to get them through the tough times, the recessions. That's half the challenge of running a bank, right? Which they're part bank, part fintech. Half the challenge is making sure you don't never get over leveraged and you don't go under in a situation where the economy gets really bad. You got a credit shock or something like that. As long as he does that, SoFi is like, oh my gosh, like they're on their way to becoming a top 15 financial institution in the world over the next decade, essentially, right? They'll just keep adding up the numbers. And then keep in mind, since they're attracting so many of the younger generation, as the younger generation increases their net worth over the next decade, 2 decades, do you know what that's going to do for SoFi's business model? Oh my gosh, the profitability becomes immense, right? The trick is you got to attract customers young, get them used to using your savings accounts, using your checking accounts, and then you can have them have credit cards and give them loans and all these, that's banking. But Anthony Noto likes to try to keep the business as asset light as possible. So he likes to take a little bit more fees rather than focus on just taking loan risk, right? My SoFi 3-year price target stock is currently 16. My bear case is $15. So this would be a scenario where we have a major, significant recession in the next 3 years, and that sets SoFi way back. If that happens, bear case is kind of basically right where the stock is right now, right? Base case, this is what I expect for the stock. I expect it to be $35 stock in 3 years from now. And then my bull case, if things go better than I expect, that's going to be a $50 plus stock 3 years from now. So a lot of upside in regards to SoFi. Number 4 of these 10 stocks under $100, that is a buy right now, is Cheesecake Factory. Cake, okay? Now, this is one that if you aren't educated on the stock, you kind of just hear this one, you're like, okay, Cheesecake Factory, yeah, that's a popular restaurant. What's the big deal, right? Listen, real quick in regards to cheesecake. They own basically several brands underneath them that are very successful, and these brands were started by a gentleman named Sam Fox. Sam Fox is a very successful restaurateur, and he sold all these different brands to Cheesecake years ago because he likes to create a restaurant concept, but he doesn't like all the corporate BS of we're going to go expand this, 100 locations around the United States, right? Because his talent is creating a successful restaurant concept, right? Cheesecakes very successful at expanding a very successful restaurant concept. They've proven that over time, right? So right now what they're doing is they're expanding a restaurant concept across the United States right now called North Italia. Very successful Italian chain that makes you feel like it might even be a local mom and pop type Italian restaurant, right? And this is really, in my opinion, going to take the place of Olive Garden over the next decade. Olive Garden, was fine for its day, but its food has come and gone, unfortunately, right? And as you've experienced better Italian food, you realize, oh gosh, Olive Garden's rough, right? And so Olive Garden has been insanely successful. And Olive Garden, by the way, is still going to be around a decade from now, I would think. But especially with the newer generations, tastes have evolved. The expectation for food quality when you go to a sit-down restaurant has evolved, and North Italia is definitely capitalizing on that, right? Then the other very successful concept they have that they're expanding across the United States of America right now, and they got a decade plus of runway to expand this, is a concept called Flower Child. Flower Child is a concept, very healthy food, much cheaper price points. You walk up there and you order it, kind of like a Chipotle, but a little different. You don't like say, I want rice, I want beans. There's a bunch of different things on the menu. You can customize it if you want. You tell them you want this. They make it pretty quick for you. It's usually ready within 5 to 10 minutes. They bring it out to you. It's good quality, healthy food, high in protein, usually low in fat. They don't have like a bunch of unhealthy stuff on the menu, and that concept's very successful. Then they have a bunch of concepts like Culinary Dropout and a bunch of others that look very promising, and they have several locations now. It's just a question of, do they want to spread that all over the United States, or are they going to keep those more regional concepts? Okay, so that's what makes cake like a very successful long-term growth story. Okay, something very important to understand there. Forward P on cake is 13. Come on, man. Like, the too much growth here regarding cake to be trading it down here. That's just silly, right? Cake, 3-year price target, keep buying right now. The stock is $56. My bear case for cake is 50. That's if we have a massive, epic recession and, I don't know, they mess up. They have some sort of health issue with the company and, I don't know, they screw up the Flower Child and North Italia expansions. Like, pretty unrealistic probability, but it's a possibility. $50, bear case in 3 years. Base case, $80. Bull case is $100 plus. Now, you gotta understand, you also get paid dividends every 3 months for the stock. So I love holding cake because I think it has great, potential long term. It makes me feel very comfortable at night holding the stock. I don't worry about it. Oh, it's going to drop to $20. And plus I get paid the dividend money, which then I can take and invest into more cake shares or other stocks when we're in a correcting market or a crash market, right? Very, very beautiful. Number 5 of these 10 stocks is, ready for this one? Might not have seen this one before. Robinhood. Ticker symbol on this one, HOOD. Hood is in the hood. It's back to a $60-something stock. Keep in mind the stock was 120 plus, not that dang long ago, right? Now, I'm just going to give everybody one warning in regards to Hood before we go further, okay? Because I'm going to give you my price targets and all that. But listen, regarding Hood, okay, just understand the next 6 months the stock could go down a lot more. Right now it's 68. Listen, if, this is a big if, but let's just hypothetically say Bitcoin's going to go down a lot more. Let's say it goes down let's say it gets cut in half again. It goes down to the 30,000 range over the next 6 months. Let's say the stock market gets hit over the next 6 months. Hood's going down to the $35 to $45 range, okay? That might not happen. I just want everybody to understand the potential downside of the stock in the short term, as in the next 6 months, if that were to happen, okay? Hood's obviously got a very long, exciting long term. I don't personally use Robinhood. I use Fidelity Investments, but a lot of stock market people like to use Robinhood, right? They'll use it for options. They'll use it for their investing accounts. They use it for trading accounts. Like, Hood's very popular. We all know that, right? And additionally, in regards to Robinhood, they've also gotten into the prediction markets. They make a lot of money off fees and kind of being the middleman, right? And being a little bit more asset light. Additionally, with Hood, they're even pushing into products like credit cards and other products. So Hood just keeps pushing. The CEO is very impressive at the company. He's done a heck of a job growing this into a $50 billion plus market cap, right? Now, Hood, here's my 3-year price targets on the stock. Obviously I spoke about the short term. Short term could be ugly if Bitcoin goes down a bunch more and if the stock market were to go down a bunch more the next 6 months, right? But the 3-year price target, my bear case is $60. That's it. That only happens if crypto and the stock market's in a bad place for the next several years, okay? Base case I have on this one is 120 for the Hood. Bull case for Hood I have over the next 3 years is 150 plus. Okay, so Hood's pretty attractive. Just understand, if things go south this next 6 months here, whatever happens with oil price and all that, just understand there could be a lot more short-term downside with Hood. Okay, number 6 of these 10 stocks is Mr. Hated Stock, Nike, NKE on this one. It's a $42 stock. Market cap's barely over 50 billion at this point in time. That's crazy to think Robinhood and Nike basically have roughly the same market cap now. That's wild, right? Listen, trailing 12-month PE is 28 on the stock, right? And people look at that and they say, Nike's not cheap. Like, why is everybody, why are you excited about Nike, Jeremy? Like, it's at a 28 trailing 12-month PE roughly, right? Listen, Nike's earnings per share over the last year is as bad as you will see it for the next decade by a lot. This is as bad as it gets for Nike. In my personal opinion, I could be wrong, but I believe by far. And the reason being is they had to take a lot of inventory write-downs. They were right-sizing inventory across the United States. They've been working on international markets, China. There's a lot that goes into that. And you have to take a lot of charges on that. You have to discount product. It's a mess, man. Also exiting other businesses. They've had one-off, termination fees of this and that. It's been a messy profitability story, right? That's going to get a lot better over the next year and over the next 3 years, okay? And so understand the profitability, the earnings per share you've seen over the last year is as bad as it gets for Nike. It only gets better from here. And it's going to get a lot better from here, okay? And so the 27 forward P, you look at the stock, you say, well, forward P is 27. I think it's way lower than that. I think analysts have gone way bearish on Nike. Nike also put out a very weak forecast for the year, I think deliberately, in my opinion, because why would you put out a super bullish forecast right now with all the uncertainty going on and you don't know what's going to happen with oil price and you don't know what's going to happen with the economy. Like, go low expectations, come in and beat those throughout the year. I think the true forward P on Nike right now is probably about, I would say 19 to 22 in my personal opinion. And that's way too low because keep in mind, this year is the second worst profitability you'll see for Nike for the next decade plus, right? So 2-year forward P on this one, 17, that's low. They're probably at like a 10 right now, in my opinion, as far as a 2-year forward P goes on this one. What about my price targets for Nike? So keep in mind that right now the stock's $42. My bear case for Nike, is $60. So think about it like this. Even under my bear case, things go a lot worse than I expect, right? The stock will still likely outperform the S&P 500 over the next 3 years. 42 to 60. My base case for Nike now over the next 3 years is 120. 120. Somebody's going to be right and somebody's going to be wrong in regards to this, right? Maybe it's me, maybe it's Wall Street. I don't know. The time will tell over the next 3 years. But there's a monumental difference of opinion between me and Wall Street in regards to where the stock heads over the next 3 years. My bull case for Nike is 180 plus, right? This is not the first time I've had a differing opinion with Wall Street. It's happened countless times, right? Sometimes they're right. Sometimes I'm like, dang it, man, they got me. That happens sometimes. And sometimes they're not right. When they sold Palantir down to $5.98 in 2022, they weren't right. I was right. When they sold Meta down to $88 in 2022, they weren't right. I was right. When they sold Shopify down to 25 in 2022, they weren't right. I was right. Tesla, we can go through a long list of them, right? So sometimes they get me. And sometimes, dang, man, they got me. They were right on that one. I think they're going to be wrong. I think this will just be another example of a stock that I saw before other people. They turn the corner, and next thing you know, it'll be a few years in the future and be like, dang, man, that was an easy buy. Like, it was such a hated stock, but gosh, I should have probably bought some shares, right? We'll see. We'll see. Time will tell. That's the beautiful thing. It always does, right? Number 7 of these 10 stocks is, actually, this is a tour. I'm going to give you 2 stocks at once here, okay? You know what they are? Honest and Fubo TV, okay? Honest, listen, this is $2.75 stock right now. My bear case for Honest over the next 3 years is $5. $5. My base case for Honest over the next 3 years is $10. And my bull case for Honest over the next 3 years is $15+. Okay, this stock is insanely undervalued. The entire company right now is selling for about $300 million. The entire company. Keep in mind, debt-free, loaded with cash to the sky, getting to profitability now. I mean, and sells needs-based products. Like, it's crazy. It's crazy the way this stock is discounted right now. Huge upside in Honest over the next many years, right? Fubo TV. Fubo, the entire company right now is selling for $1 billion, right? They're talking about $300 million of adjusted EBITDA per year in, just a couple years from now. Currently, the stock's $12. My bear case is $12 for the stock over the next 3 years. My base case, $25. And my bull case is $100+ 3 years from now, right? Fubo's one of the highest upside stocks, I think, in the market. It comes with risk, absolutely, right? But I think it is one of the highest upside stocks over the next, 3 years, if not over the next 5 years. And we'll see what happens, right? But is it possible that Fubo could become a $7 billion to $10 billion company over the next 3 years? It's possible. They've got to show lots of user growth, lots of increasing margins, profitability. They now have the Disney relationship, right? Hulu Plus Live TV. Continue to expand that. And I think we could be looking really, really good in regards to that one. So 2 very small companies, very, very small ones. That's why I just combined them together here. And very different business models, right? One sells diapers and wipes and soaps and all those sorts of things, and a lot of baby care products and some cosmetics products. The other one is obviously a streaming company that is very, very successful in the sports space with their Fubo brand. And then Hulu Plus Live TV is just, successful overall. Okay. Already, number 8 of these 10 stocks is Estee Lauder. Estee Lauder, EL stock. This is a higher end cosmetics and beauty company overall. Most of their brands compete kind of in the higher end space in general, right? Forward P on this one's 25, okay? But I want to talk about something bigger here. They own many of the most successful brands that are high-end brands in the makeup and beauty industry. Go into your local Nordstrom, okay? Go walk around the makeup and beauty department, try not to look like a freak, okay? And walk around and just see a brand and be like, type it in and say, who's this owned by? You're going to find many of them are owned by Estee Lauder, okay? They have, I don't want to say they have a monopoly on that space, but they have definitely a very successful foothold on the higher end cosmetic space, okay? But I want to speak about something bigger here for a moment, because I think this matters. Because you're going to see several companies are featured on this list today that are consumer companies. They're really B2C, right? They're selling directly to consumers. Now, why am I so bullish on the consumer over the next 3 to 5 years, right? The reason I'm so bullish on the consumer over the next 3 to 5 years is a lot of it has to do with where's most of your money go as a human in the United States of America, right? It goes to either rent or to your mortgage. Now, rents have died, right? Rents went through a crazy increase for years, coming out of Rona, essentially, right? Started in 2021. Rents were just ballooning. Now, they claim rents are up 2% over the past year. I call BS on that. And the reason being is even a lot of these apartment complexes and things like that have started to do these deals where they'll give you 1 month free, 2 months free, 3 months free, with a 12-month, signed contract or 15-month or something like that. So I actually think rents across the United States, I believe they're actually down right now, or at minimum flat right now, okay? And that's for the United States in general. But this data claims rents are up 2.9%, right? But the moral of the story is that's a long way from 7.52%, 5%, 8%, 6%, 7%, right? We're back into normal ranges. Now, this is when consumer companies were doing amazing, right? 2014 through 2019, actually, we can call it 2010, right? Coming out of the great financial crisis. 2010 to 2019, consumer companies did amazing. And one of the reasons being is rents were not out of control. Home prices were not out of control. So the biggest expense people had was a very controlled manner, right? And so consumer companies were in kind of a golden age there, right? Suddenly you have everybody's biggest expense, which is usually the rent or the mortgage, go insane, right? If you're wondering why so many consumer stocks have gone down considerably over the last 3 to 5 years, look no difference than rents. Go look at home prices, right? Now, when we look at home prices, this is median sales price of homes in the United States. We've been now downtrending for a while. This is likely going to continue to downtrend, at least in the short term, right? And so you had this huge boom, obviously from median sales price being like 320,000 all the way up to 440,000 plus at the peak, right? Now we're getting close to right around 400,000, right? Which is obviously many years later, wages have gone up, things like that. So I'm very, very bullish on the consumer the next 3 to 5 years. And that's why you see me buying a lot of these beaten down consumer companies that have been wrecked, right? A lot of these stocks, many of these consumer companies over the past year have hit 8-year, 10-year, 12-year, and 15-year lows. You're getting these stocks at the cheapest you could get them in the past decade or two, right? Or rent's going to massively all of a sudden suddenly increase over the next couple of years. I don't see it. Or home price is going to go crazy over the next couple of years. I don't see it. right? 10 years from now, who knows? We could have a whole new housing cycle that makes home prices go crazy again and rents go crazy again. But in the next year or two, it's not there. Home prices will be flat or down, rents will be flat or down, or a very slight increase, right? Which is manageable, which means then people have more money to spend with Estee Lauder, with Nike, with all these other consumer brands that have, you could pull up almost any consumer brand out there, consumer company, their stocks are almost all down 50 to 80% from their all-time highs. It's been ugly, and you can understand why when your biggest expense goes crazy, right? No, as far as EL for my price targets, my EL 3-year price target, keep in mind the stock is $68 currently. My bear case is 100. When your bear case is significantly above current price, that's good news. That's pretty bullish, right? My base case for EL, 155, 3 years out. My bull case for EL is 200 plus 3 years from now. I like EL stock a whole lot. Number 9 of these 10 stocks it's a new one, Bath and Body Works, BBWI. That is a ticker symbol on this one. The whole company sells for $3 billion plus market cap right now. It's an $18 stock. Forward P is under 7 in the stock. It's a very simple business. They sell candles, lotions, soap, stuff like that, right? Very popular around the holidays. Always one of my favorite stores to go in. Okay, I'm in touch with my female side. No, not female side. What do they say? Your feminine side. Female side. I'm not in touch with that, okay? Your feminine side, okay? I love going Bath and Body Works. Don't judge me. I go there Halloween. I go there Christmas, man. I love it. I love to get those little soaps. They smell like candy canes, and go there and get those those pumpkin soaps, in fall time. Just makes me feel good, okay? Judge me all you want. Go to Bath and Body Works. Go get some of that this fall, okay? But anyways, moral of the story is this stock's very undervalued here at a forward P of under 7 on this one. It pays a fatty dividend, by the way. Bear case on this stock the next 3 years is 25 for me. It's 18 right now. Base case 32. Bull case 40 plus. Once again, don't forget the fatty dividend on this one. That dividend yield 4.3%. And it's a pretty low payout ratio too, so they could definitely up that dividend in future years if they want. So I like Bath & Body Works. What can I say? I think it's a very attractively priced stock. And don't be surprised if I start buying the stock sometime soon, okay? Number 10 of these stocks, the last one of them all. It is, this one's another hated one right now. It's so hated, and it is ServiceNow. Ticker symbol on this one is NOW, NOW. What a perfect stock for this one. Now listen, the stock technically closed at $100.55 today. When I was prepping the video, when I was thinking about making this video, it was 99 earlier in the trading day, okay? So, hey, I'm sorry, but it was $99 earlier today, okay? ServiceNow, do some digging on this one. This is, of the SaaS related companies that you could be worried about getting replaced by AI, this is one of the least you should be concerned with. This one really connects companies internally, communication wise, and it just makes everybody's life a lot easier in a large company. Let's just say that, okay? Forward P on this one, 23, somewhere around there. Company's grown revenues and earnings per share around a 20% clip. I mean, for a SaaS company, it's a buy. What can I say about it? It's a buy at $99 or anywhere near this price, right? So as far as my price targets on this one, bear case is $0, base case $0, bull case $0, because that's what Wall Street thinks about all these SaaS companies, right? They're all irrelevant. Once again, the main pinned comment down there, that'll be if you're looking to apply to join a private stock group, private wealth group, get access to 1000xstocks.com, private Discord chat, exclusive weekly videos, all of my premium courses, all that good stuff. See the moves I'm making out there in my real money portfolios. And then additionally, if you want to follow me on Instagram, give me some opinion, right? Send me a DM, reply to my latest story. That'll be the second pinned comment down there. All types of crazy moves. Okay, we have Fubo up almost 25% here today. AMD, we got to talk about that stock at the beginning of this video here today. We got to talk about SoFi at the beginning of this video here today. Do some stock talk. Also reveal my potential buys watch list at the beginning of this video here today. So got a bunch of stocks to talk about at the beginning here. From there, I want to react to this video. Tom Lee, the risk reward is quite good for stocks now, says Tom Lee. Looking forward to reacting to that video. And then Jamie Dimon, arguably the most important man in the world when it comes to the finance banking sector, right? He put out a annual shareholder letter, talked about a lot of risk out there, things like that. So looking forward to reacting to his little video. Appreciate you for joining me, by the way. One thing, all I need from you guys is a little smash that like button. I hope you had a great long weekend. I'm ready to rock and roll. and get into all this craziness. And we got earnings season. It's coming, baby. It's coming. It really gets kicked off the end of this week, and then especially into next week. And then it's going to be craziness for the next 4 weeks after that. Okay. Pin comment down there today. Put together a free workshop for you guys, how to manage your portfolio every stage of wealth from your first $5,000 to $1 million plus. So it doesn't matter where you're at in your journey in regards to running a portfolio. I give you kind of tips, tricks, steps on how to manage your portfolio best, regardless where you're at. It's a 35-minute video that will be pinned comment down there. It is free to access that. Okay. Alrighty. So let's go here. Okay. AMD right off the bat. Listen, if you're an AMD shareholder, you need to be very excited. You need to be very excited, okay? This is since the whole Iran situation kicked off, okay? AMD has gone up almost 11%, while the S&P 500 is down 3.5%. AMD is showing major outperformance. This outperformance could get much more substantial as the next few months tick on. The reason being is 450 series really goes into mass ramp over the summer. And so as you go along this spring, essentially, I think there's going to be a lot of hype and excitement that continues to come into AMD stock as we get closer and closer to some insane numbers that, we haven't seen those sort of growth rates in AMD that we're going to be seeing later this year. We haven't seen those sort of growth rates in AMD in a long, long time. And so AMD's got great growth rates as it is right now. But I'm just like, they're about to kick it up to a whole other gear. And so very exciting times for AMD. If you're an AMD shareholder, just sit back and have some fun over this next bit of time, okay? Fubo is making a huge move here today, about 25%. It's been up here today. Now, in regards to them, so they had some pretty exciting news that came out here today. Fubo today announced adjusted EBITDA, earnings before interest, taxes, depreciation, amortization outlook for fiscal 2026 and 2028, and affirmed its cash forecast. Fubo TV is the strongest financial position in our history based on current outlook, says Dave Gandler. Yeah, 100%. I think that's just a very fair take. Like anybody that understands income statements, balance sheet, those sorts of things, Fubo's in the best position they've ever been in by a mile. It's not even close, right? Guidance and long-term financial targets. Fiscal 2026 pro forma adjusted EBITDA guidance of $80 to $100 million. That's this year, right? Fiscal 2028 adjusted EBITDA target of at least, this is the key word, at least $300 million. So that's just 2 years from now. It's not like this is like a 10-year from now forecast. This is a couple years from now, right? Talking about at least adjusted EBITDA of $300 million. That's big. Positive free cash flow expected fiscal 2027 and fiscal 2028 under current operating plan. This is massive. Based on our current outlook, we expect to deliver between $80 and $100 million in pro forma adjusted EBITDA in fiscal 2026, and we are targeting at least $300 million in adjusted EBITDA in fiscal 2028. Wow. I mean, this is quite substantial. Now, the biggest thing, takeaway from this in the end, right? The biggest takeaway is this means essentially Fubo is good from here on out. They don't need outside capital. They don't need to, dilute shareholder value. They don't need any of that. They're good. They're good, right? And so they don't need to take out massive amounts of debt or something like that. They're good now at this point in time, right? Now, they talked about based on our current operating plans, we have enough cash to fund our business. That is key. So if you're thinking, is there a big dilution coming? No, they just took that off the table completely now. We have enough cash to fund our business, including debt obligations, and invest in our growth. We expect to be in a net cash position, cash and cash equivalents exceeding all debt in fiscal 2028. Manage our debt levels while extending our maturities. Today, we have approximately $323 million in debt obligations with no maturities until 2029. As of March, our 2029 bonds are trading close to par, which we believe reflects credit investor confidence. Our financial stability, which we do not believe is reflected in our stock price, I agree with that, has continued to improve. Importantly, this trajectory that we expect to continue. I'm confident in the future of the business. Our financial position provides us with flexibility to invest, to compete, and to serve our customers at a higher level than any point in our history, right? So, this is the best news you could get in regards to Fubo. This doesn't surprise me, though. This doesn't surprise me at all. Oh, by the way, Fubo as a company continues to offer NBC Universal content through Hulu plus Live TV. As a reminder, Hulu plus Live TV operates at a significantly larger scale. While we acknowledge that the Fubo service does not currently include NBCU content, the impact of our overall company has been modest. This is because of the impact of Fubo's service has been lower than expected. Additionally, many customers, including existing Fubo customers who seek NBCU content, may access that programming via Hulu plus Live TV. Because that was one of the other things, because, like the Olympics was on NBC and those sorts of things, right? So, I mean, this doesn't surprise me personally at all. And this is why I've been buying Fubo stock, right? But I think for anybody that was concerned, didn't know, right? I think this is just good news to hear from the big dogs at Fubo, right? And so, good news. I mean, good news all around for Fubo, right? If you're a Fubo shareholder, today's a very exciting day. And there's much better days ahead for Fubo stock, I'll tell you that much, okay? Okay, so next up here, we got Elf making a almost 4% move here today. Cheesecake making about a 3% move. Celsius, look at Celsius today, 4% move there. SoFi, here's the deal with SoFi, okay? Listen, if this market's about to go back risk on again, SoFi's going to fly. Like, that company has the big growth rates. And so as soon as you start going risk on in the market again, money's going to come flying back to SoFi. At the end of the day, they have the big growth. If you look at the banking space, right, in fintech, you're really not going to find anybody that has the sort of growth rates SoFi does. They're a one of one. And so just understand, as soon as the market goes risk on, SoFi's ready to move big again. And next thing you know, it'll be back over 20. Now, can we push back to 30? That's going to probably take a little bit of a longer time period. Keep that in mind. Stocks, a lot of times, if you've been in the market a long time, you know this expression, they take the stairs up and the elevator down, right? So a stock can move up, but then, when things get crazy, they just tank hard. And especially with growth stocks, which SoFi is definitely a very high growth stock. So SoFi sets up very, very well as soon as we go risk on. Now, if the market sells off again, SoFi will sell off with the market, and that's just a tremendous buying opportunity for people that want to be invested in SoFi. Not everybody does. There's risk that comes with SoFi, right? They are in the banking space. They are in the lending space. They try to stay as asset light as possible, which helps in regards to making it through the storms. They try to be as fintechy as possible in as much as, taking fees rather than, just taking all the risk of loan balances. But with that being said, there's still risk that comes with that stock. We all know that, right? But it's a risk I'm willing to take. Like, for the future of banking and fintech, like with those sorts of growth rates, I'm willing to take that risk. American Express up a little bit here today. Let me show you my potential buys watch list here. By the way, something I think is interesting before we go to my potential buys watch list is big tech. Big tech's still a mixed bag, and that makes you think like the market's still trying to find its footing here. The market's still trying to find its footing. When you don't have big tech still, it's still a lot of uncertainty, right? Tesla's still very weak. Microsoft's still weak. This stock has obviously been hammered. It's come off the lows, but it's been a brutal past many months for Mr. Softy. 6 months, Mr. Softy's down 28% versus the S&P 500 is only down 2%. On a 3-month, Microsoft's down 21% versus S&P 500 is only down about 5%. I mean, that's not good. Mr. Softy's been hammered. I like the stock, actually. Even on a 1 year, Microsoft's only up 4%. Meanwhile, S&P 500 is up 30%. On a 5-year, look at this. Even on a 5-year, Microsoft's losing now. S&P 500 is up 60% in the past 5 years. Microsoft's up 45%. I like Microsoft here. I don't love it. I'm probably not going to buy it because there's better opportunities, in my opinion, in the market right now. But with that being said, wow, that is fascinating to see it down there. MU's getting hot again. MU's the most risk on risk off stock in the market right now. That's one of those stocks that, market starts going up. Oh my gosh, MU just goes on a rip or rally, market goes down, MU is getting destroyed. So very risk on, risk off right now. Let me show you my potential buys watch list. Here it is. So my potential buys watch list, this is in no particular order, right? Bath & Body Works is on there. I would like to maybe start a position that one if it goes like 15, 16 range. 17 is also good. I mean, even 18 is good with how cheap the valuation is on it for Bath & Body Works, but I would love it a little lower. Honest, I love Honest. Like, I think that stock's 5+ by the end of the year, regardless of the market conditions, but we'll see. But I would love to pick up some more Honest here. Nike, we all know how I feel about Nike. ServiceNow, yeah, that one remains a buy. Right around 100, or especially if you can get it under 100, ServiceNow's a buy in my opinion. Meta is a long-term buy. Just don't get excited about the short term, right? They also made an interesting change with Meta. I don't know if you guys saw this, but they're kind of exiting letting people use credit cards for ads from what I'm understanding, and they're starting to give you like it's interesting the way they're playing the game. They're also kind of like crediting people, like people that have ran a lot of ads over time, kind of giving them like almost like I don't want to call it a credit because it's not really a credit, but almost like an advance so you can run more ads, right? Even saw one guy on social media the other day, he's talking about we now have an extra $1.2 million to play with to run ads, which is interesting because I just think if they do something like that, it could actually push up the amount they're able to charge for their ads quite considerably, which obviously would be very beneficial to Meta. So I don't know how all that's going to work out. I'm sure they run the numbers on all this stuff, and whatever they're doing is the right decision, right? Adobe remains a buy. PayPal. Whirlpool is one I'm still taking a look at here. Amazon's always a buy for long-term investors. It's been a buy since it went public in the 90s, and it's still a buy this day. American Express is always a buy. It remains a buy today. Robinhood, you know, if you've got a bottom on Bitcoin, then the hood's already bottom. But if that baby keeps going lower, and let's say, you know, Bitcoin goes into the 30K range this fall, Robinhood's got a lot further to fall. You know, Robinhood will definitely go under 50 in that environment and potentially even into the 40s or 30s if that were to happen, right? SoFi, we already talked about SoFi. Estee Lauder is a huge buy here at $70. I mean, especially if you can get it under that. Cheesecake's always a buy. RH is interesting. I'm not really ready to step in RH, but I'm keeping an eye on it. Elf's a huge buy right now. Celsius is a huge buy. By the way, RH I would already be buying right now if it wasn't for this. There's so many other deals in the market, man. Like, would I rather buy RH at 117 or Elf at 63 or Celsius at 35? I would definitely rather buy Elf or Celsius. That's a tough thing in this market right now. You have a lot of good deals, but you have to pick what's the best deals, right? Hims remains a buy. Fubo, by the way, even up 25% today, it's still a buy, just to be clear about Fubo. So, you know, that stock's been taken to the slaughterhouse. And so, yeah, even up 25% is still a buy today. Hims, keeping an eye on that one, still doing more digging there, okay? Alrighty, now let's go ahead, let's react to some videos, including Tom Lee. By the way, second pinned comment down there today, if you're looking to access all of my premium courses, access my private Discord chat, exclusive weekly videos, all that good stuff, that will be the pinned comment down there, or second pinned comment down there today. The first pinned comment, once again, will be for that free 35-minute workshop I put together for you guys on managing your portfolio for every stage of wealth. Tom Lee.
Fundstrat Capital as well as a CNBC contributor. Good to see you, Tom. March came in like a bear, stayed like a bear for, I think it came in about 6,900 on the S&P. We got 6,350 or so, and then a bounce. Last week, we're back to 65.80. Your call, I think like so many of your calls, there's some volatility near term, but then a successful resolution by the end of it. That didn't quite happen in March. I think maybe things are taking longer than you thought for the war, but you're kind of just pushing it back a month, are you not?
Yeah. You know, as March unfolded, the war looked like not to be a short war, but, you know, one that was longer. And I think markets have been adjusting to that. But as you know, we're still in the midst of this fog of war because we don't know when it ends. But we did look at the past 7 major war events, and the stock market adjusts pretty quickly. Within the first 10% of the entire duration of a war, the stock market usually bottoms. So, you know, World War II was almost 5 years, and the market bottomed 5 months into that war. So I do think, as bad as March was, we've probably seen a big part of that adjustment. And now I think the risk reward is quite good for stocks.
And 90 to 95% of the weakness is behind us, in your view.
Yes. And I think people are kind of torn because if someone sold in March and the market, they may have sold 3 or 4% off the highs, and we're just 5% off the highs. They've got a dilemma because the market's only a little bit lower than where they might have sold, but it wouldn't take a lot for the markets to begin to recover. So I do think investors who've gone to cash really have to start to think about.
Bingo. Listen, ladies and gentlemen, that's the hardest thing about trying to sell out of your stocks, sell out of your portfolio, and play the whole game of, I think we're going to go lower, so I'll buy back in at some point in time, right? And it's like, okay, let's say you did that at some point in March when everybody else was selling. And now you're looking and you're like, crap, like maybe your stocks are around the price you sold at. Maybe they're a little lower. Maybe they're a little higher, but you're playing this big game of chicken now and you're like, what am I going to do? What am I going to do? Am I going to buy back in? Am I going to wait on the sideline? And imagine the market starts going risk on again. All of a sudden, next thing you know, NASDAQ's back at new all-time highs. Dow's at new all-time highs. S&P 5. And all of a sudden you're like, should I jump in now? Like, that's a tough position. And so, people tend to freak out during these time periods of craziness. Just don't do it, man. Just stay cool, stay through it. I don't care if we have a crash of 50%, stay invested. That almost never happens. But if it happens, stay invested throughout it, buy the whole dip. Got more income than expenses, you're good to go, right? You're not retiring tomorrow. So that's the name of the game. Otherwise you're playing this game and it's just brutal. I mean, the toll it takes on you mentally is just exhausting of trying to figure out, should I buy back in? Should I not? Should I, and then the market starts working against you. You're like, crap, and even if the market starts going down, you're like, okay, I'm a genius. I pulled this off, right? Still, when do you get back in? When the S&P 500 is down 10%, what about 15? What about 12? What about 20? What about 30? Who knows how low it goes, right? And it's just a brutal game to play. So I would advise everybody, it's been proven statistically and mathematically to also be a bad decision. To try to play that game, I'm out of the market, I'm in the market. Come on, man. And you could spend all that mental energy on what? You spend all that mental energy on focusing on studying great companies and what makes them great, right? Listen to conference calls, running projections, running numbers. You could spend your time doing that, but alrighty.
A war, as much as it's a crisis, people focus on the negatives initially, but then they need to start thinking about the opportunity on the other side.
We talked about the false start in oil when it sold off. There was also a day where we were down 200 or 300 points. Trump said something, we were up 1,300 points. So is it spring-loaded right now, but wary? It's I think everybody's like, well, yeah, we've seen this before. We're going to need more real evidence before it makes a move again like that. But what kind of move would it make if there was a definitive agreement that Iran even admitted to? Because they haven't admitted to anything yet, but that's their playbook.
Yeah, I mean...
You think spring-loaded?
Really spring-loaded, because one, we know that policy and the path of the war is more important than the central bank. So that's the single biggest driver of the stock market. The stock market's getting a bit of a boost from all the defense spending. So the economy is not in horrible shape.
Oil stocks are doing pretty well, too.
Yeah, oil stocks are doing well. But then if there's Middle East peace, of course, that's got a lot of future benefits. So I think if there is a surprise and the war does end, the reaction would be very explosive, as you said.
I just want to read you what, and we're talking what Leslie was talking about earlier. This is the Jamie Dimon letter. Mostly bullish, but then makes this point at the end, sort of one section, where he says the skunk at the party, and it could happen in 2026, which is now, would be inflation slowly going up as opposed to slowly going down. This alone could cause interest rates to rise, asset prices to drop. This would make Kevin Warsh's life a lot more difficult. And interest rates are like gravity to almost all asset prices. And falling asset prices at one point can change sentiment rapidly and cause a flight to cash. Your reaction to that?
Well,
and that's, by the way, his downside scenario. I mean, that's sort of how he's laying it out.
I think that's everyone's concern, because we've had several inflation shocks now in the last 6 years, right? The first was the COVID supply chain, and then was the tariff shock, and then this is a war shock that's going through, and nobody wants consumers to suddenly expect higher prices. So I think that's what everybody is watching carefully. But it doesn't mean that just because prices are going up because of this, of gasoline, that inflation expectations are unanchored. So I do think right now it's a critical time for the Fed to have credibility and for consumers not to expect higher prices going forward.
So 7,700 is still your call by the end of the year. Becky and I, we did some great work on Friday. I don't know whether you saw, but
full hour's worth.
We did an hour, but we brought a really good jobs number to the that was a surprise to everyone. The risk on both sides of the dual mandate has been in the forefront of everyone's mind. You can't even, they're both so bad, you can't even figure out which one is worse. Did that alleviate the weak labor market fears, the recession fears that have been creeping into the market because of the war?
Yes. And I think investors need to keep in mind that wartime spending is, $30 billion and maybe going up to $100 billion a month of economic stimulus, and that does boost the economy. Gasoline, every $10 is about $4 billion to $5 billion a month hit to the consumer. So the monthly spend from the war is much higher than the effect from oil.
That is a cynical viewpoint about war.
Yeah.
Forever about war, about help.
Is that why you are not as worried about inflation sticking in there for the longer term?
It's if this is a shorter war and the oil curve doesn't seem to expect it to be into year end, then it's an inflation shock, not a inflation
but
episode.
You don't think the Fed's going to be cutting rates anytime soon if it's not worried about the jobs picture?
No, it wouldn't make sense in the near term. I mean, I think market expectations are correct.
Crypto's fine. You're not, yeah.
Well, after energy stocks, which have done well since the war started, the second best performing asset is Ethereum, and the third best is Bitcoin. They've both been up on an absolute basis and beating the equity market.
That's an interesting take. Let's go ahead and let's do some digging now. Let's see if it's accurate here. So he wants BTC, right? And first we need to pull up about when things started here. So which was the end of April. Oh, come on. Is my trading view not working? Oh my gosh. I cannot get my charts to work. Great. You flip my flapjacks here? Well, maybe I'll go 3. Well, maybe it's because Bitcoin won't allow me to. Let's go 3 month. Well, I still didn't go 3 month. But anyway, so we need to go to right about here. Okay. So, yep, Bitcoin's looking good against S&P. Let's go with Ethereum. Let's go AMD. AMD. So, wow, look at that. Ethereum beating AMD even. Dang it. Bitcoin's losing to AMD, but all three are actually beating the S&P 500. Interesting. All right. Okay, Tom Lee. So next up here, Jamie Dimon, arguably the most important man. Should I say arguably? No, he's the most important man in finance and banking. Jamie Dimon.
From Chairman and CEO Jamie Dimon this morning on AI. He's saying that investment in AI is not a speculative bubble, and he said, quote, in the long run, it will have a huge positive impact on productivity. He's saying AI will definitely create and eliminate some jobs, and it, quote, will also introduce serious new risks from deep fakes and misinformation to cybersecurity vulnerabilities. On private credit, Dimon noting that actual...
That's a big statement. So Jamie Dimon tends to be what? He tends to be very cautious. He tends to be kind of tell you about those scary parts. When Jamie Dimon says this is not, the AI spending is not just speculative, crazy spending or something like that, right? That's good news, right? He looks at this stuff very heavily. And running Chase, I think you get the most in-depth look at anything. And to be fair, I think most of the AI spending is very justified, right? By many companies, maybe not all of them, right? There's never going to be 100%. But the use case of AI have exploded over the past, we can call it 24 months, right? It went from almost no one used AI in any frame 24 months ago, unless you were super technology forward-looking person, right? To now, I would say the far majority of people out there are using AI in some way. It could be to edit photos or videos. It could be, for something work related, right? That they have to use some sort of AI to help assist them in some way. It could be just in their personal life, using Grok or using Gemini or using ChatGPT or whatever, right? Like now I feel like almost everybody is starting to use, an AI in some form or fashion. And that's a big change just over 24 months ago. And so obviously those use cases are going to continue to climb and increase for, years to go in the future, right? Like maybe even decades to go in the future. So, but all the spend, is it justified? I don't know. We'll have to find out longer term, right? Like, Amazon spends $200 billion this year. Is it all justified? I don't know. Maybe it is. We'll see. What are AWS numbers? Meta, same thing. We gotta see with the growth rates over the next year or two, and that's going to tell us a lot.
Right now are already a little higher than they should be relative to the environment. And he writes, quote, by and large, private credit does not tend to have great transparency or rigorous valuation marks on their loans. He said at some point insurance regulators will insist on more rigorous ratings or markdowns, and said if anything goes wrong, retail investors will seek remedy in courts. However, Dimon said private credit is probably not a systemic risk. Dimon has a long section in the letter, guys, on bank regulations, and said their initial reactions to the new proposals that came out a couple weeks ago were mixed, with some aspects that he thinks are, quote, nonsensical. He said JP Morgan would have to hold as much as 50% more capital on the majority of their loans compared with mid-sized peers if these proposals were passed. And then lastly, in terms of the broader economy, Dimon saying it continues to be resilient while noting some recent weakening of the consumer. He reiterated what he told us last month in Miami, that the, quote, skunk at the party, and it could happen in 2026, he said, would be inflation slowly going up. He said the Iran war could drive up inflation and interest rates, and warned of the potential for further oil and commodity shocks from here, guys.
Leslie, what was your sense? I mean, the interesting part to me about that letter was the skunk at the party line, which you pulled out, and the private credit piece more than anything else. Having said that, I did think that his commentary around private credit, while not arguing that it was systemic, raised some questions just about the marks piece of all of this. And as you think about sort of legislation or regulations, about how people are going to think about some of these marks and even the way insurance companies are marking some of this stuff.
That's what I thought was really interesting, too, because we've heard him talk a lot about private credit, but honing in specifically on this transparency issue, on the marks issue, that felt pretty new to me. And then also just the regulatory implications of all of this, specifically the insurance regulators, which a lot of these, of course, are in insurance vehicles. You've got Athene, for example, which is tied to Apollo and so forth. And then the retail investor aspect as well, seeking remedy in courts. That kind of echoes what we heard from Lloyd Blankfein, this idea that, all is fine if you sell it to institutions, but once it starts going in a big way into retail portfolios, if anything goes wrong, it could be a big reputational risk.
Well, and we've watched it, obviously, with Blue Owl last week, which continues to hemorrhage, both in terms of its stock price itself and then all the folks who seem to want to get out of those vehicles. The question is if there's a reason for anybody to get into those vehicles in this moment to take some of the pressure off of them. And if they don't, what happens? I mean, the sort of irony is we haven't reached a point yet in the private credit land where all these software companies, which everybody's so worried about, have gone belly up and therefore have hit the credit market yet, right? So it's all in anticipation of something.
Yeah, and that's what's kind of interesting, because in a few of these vehicles, and interestingly, despite all of the redemption requests in those two Blue Owl funds last week, they did still see inflows. And of course, they capped the redemption. So combined with the gating that they chose to do and a little bit of inflows, they didn't have massive outflows. Now, some of them, they just didn't allow the outflows to happen. As a result, the fund size stayed basically the same, which means that, they didn't forego much in the way of fees. And the question, I think, is a good one, Andrew, is who is going to be, the marginal inflows from here if not for retail? Is institutional tapped out? Are they still even interested given all the negative headlines?
So something important I got to explain to everybody here, okay? Listen. Money has to go somewhere. Money has to go somewhere, right? People that have a lot of money, they have to put it somewhere, right? There's a ridiculous amount of millionaires, multimillionaires, billionaires throughout the world, right? It's unbelievable. I don't want to say unlimited amounts of money, but almost unlimited amounts of money, right? Just ridiculous. Money has to go somewhere. So you have some options. One, you can literally just keep it cash. Listen, we're in inflationary times. We've been in inflationary times. It's nothing new. You keep it just in cash, straight up. Your dollar's being devalued day by day, week by week, month by month, year by year, right? Like, horrible decision. So you can't just keep it cash, just in a big vault somewhere. It's not a good decision. Okay, so where do you go from there? You can go treasuries. Treasuries are yielding pretty good right now. Treasuries have gone up a lot in the past month and a half, roughly. So, you can put in a 10-year, you can put a 2-year, you can do what you want. There's definitely good, decent yields out there that are above CPI, significantly above CPI. You can put money there. You could put money in private credit if that's what you want to do, right? You can give the money to VC investors if that's something you want to do, right? Maybe the VC investors invest in the next hot AI company that changes the game, right? Okay, you can put in real estate. Real estate's not really doing much right now, right? People are just not enthusiastic about real estate at all right now. The real estate investors are, for the most part, still non-existent in the real estate market. So real estate's just a no touch for most right now, right? Some that might change over the next few years, but as of right now, it's still. So then you have stocks. Stocks kind of worry some people right now, right? But other people might look at it, especially with SaaS stocks. They're talking about SaaS stocks, right? Look at the valuations of these companies, like Salesforce, like ServiceNow, like Adobe, and look at their growth rates, right? Look at Microsoft. And then you can go through big tech companies and their sorts of growth rates. I mean, Meta's probably going to have revenue growth, 30% or more in this quarter they're about to report? Gosh, that's pretty darn exciting. Where's AWS growth rates for this quarter Amazon's about to report? Mid-20s? It's pretty exciting. Maybe even higher than that. If we're talking higher than that, oh boy. So where do you put your money? It's got to go somewhere. And that's a part everybody's got to always understand. Money has to go somewhere. And so it could go there. It can go there excitedly, or it can go there reluctantly. But it's going somewhere, right? And so keep in mind, there's probably been a lot of people putting a lot of money in treasuries over the last, 6 to 7 weeks. A lot of money, right? Because treasuries have been going up. Why not move money into treasuries and out of stocks, right? And definitely a lot of people sold stocks in the last 6+ weeks. So now you could get an interesting phenomenon. Let's say treasuries start going down for whatever reason. Maybe, things chill out. Oil price starts going down. GSG starts going down. The inflation fear starts to subside. And next thing you know, the 10-year, 2-year, just treasuries in general just start falling, right? Well, then you get all of a sudden that money says, okay, let's move back into stocks. And the next thing you know, market's at all-time highs. So something to just keep in mind here, ladies and gentlemen, is money's got to go somewhere. Never forget that. Money's got to go somewhere. And it can go there reluctantly, I got to put it here, I'll just put it here. Or it can go there in an exciting fashion. Exciting fashion is usually in a FOMO market. Or you went through a crash, right? And people are excited. They're like, oh, we already went through a crash. Or, oh, it's going to the moon, woo. Okay, so that wraps up this video. I appreciate y'all for joining me. As always, thanks so much for being here. Once again, that free workshop, it's a 35-minute workshop I recorded for you guys a couple weekends ago. That will be the pinned comment down there today, the main pinned comment. That is going to be free to access. You can send it over via email or via text, however you want to receive it. Second pinned comment down there today is for those of you that are looking to apply to join private stock group, get access to all my premium courses, access to 1000xstocks.com, access to exclusive videos from me, access to see the moves I'm making each week, all that good stuff, okay? Much love and have a great day.